Good morning, everyone. This is Rose. Today is May 17th, Friday, 9 a.m. Eastern Time. Hello, Rory. Hello, everybody. All right, let's begin. I had some data connection issues, but let's see. For some reason. All right, I want to start with the news items. We have not much going on today. There's e-commerce retail sales around 10 o'clock, and nothing really after that other than Christopher Waller, the Fed member, is going to speak around quarter after 10 a.m. And then Mary Daly is going to speak around noon, quarter after noon. Nothing's really scheduled important as far as the news goes, but today's Friday. So we can get swings both sides of the market. So yesterday, I want to talk about yesterday a little bit because it was really good price action. It was a good continuation, 50%. So let me get my pointer. So when the prior day is bullish, and it's actually rallies end of day or last couple of hours, you're going to get a follow through buying, the 50% follow through buying at the open the next day. Even though we had a very strong bear bar at the close, what seems like a bear flag, market actually went sideways, and probably there were sellers, so they had to sell up here and exit with bar 8. In the meantime, my bar numbers are not showing, so let me get the bar numbers situated. I'm not sure why decided to disappear. I upgraded to Windows 11 and everything's again glitching. I don't believe Windows 11 is a reliable operating system at all. At least for those old machines that are trying to move from Windows 10 to 11, and I'm getting a ton of problems. My pointer cast is no longer working. It seems like it's working, but it doesn't display, so I can't use the tool. The NinjaTrader is reacting. I'm getting really bad data connection issues, or corrupt files suddenly, or things are disappearing. So I tried to roll back to Windows 10, but I couldn't figure out how to do it, even though it was an available option to me before. So it just, I have to look into this over the weekend and see if I can actually roll back to Windows 10. Anyway, so let's see. Just give me a second. Let me figure this bar number situation, why it's disappeared. Bar counter is active. So the indicator, okay, it just needed some kind of appeared. Bar counter is active. So the indicator, okay, it just needed some kind of all right, let's get back. It needed a refresh. All right, so you get basically your 50% follow through here, okay? Okay, so basically bar 8 here, okay? Basically anyone who sold us as a bear flag, sold again, and then got a good exit. And to me, this right here is a double bottom bull flag, and we have a slight gap up, but we had trading range highs. Good place for bears to sell and bulls to maybe wait for a breakout. So breakout bar 9, it's okay, but it's not the best breakout. You can see it's a breakout from this inner high or the lower high, but it's not from that higher high. So, and it's got an upper wick, so I'm not very excited about bar 9. But the bar 8 is signaling me that the limit order buyers are at the EMA and they're buying. So I is actually put a buy order right there, and the stuff underneath, I actually went long. Now, this was my measured move targets, and even though the breakout wasn't all that great, but then we got the second breakout. So this the follow through bar with bar 10 is now all the risk is going to move from underneath 8 to 9, and then as we take out this pullback high, more bulls are entering above bar 14. Stops are going to go higher. Now, I wouldn't put the stops underneath 17 because we're already made 1, 2, 3 wedge top here, bar 2, bar 12, and bar 19. We're going to come back down to the third leg starting point. So we're going to test here. So if you move your stop from here to here, if you haven't taken any profit with this bar, your stop is going to get hit. I wouldn't do that. Anyone who's stuck here, they're probably going to buy again. They're going to try to prevent their stop from hitting. So if you actually have a stop, you're going to get nervous there, but your stop is probably still, okay, if you put it like a point below bar 13, you're actually still safe, but barely. But the reason why it came down here, well, it's just a wedge stop, so it's coming down. It wants to run more stops. But you see this bar 21? I told everybody that this bar puts us into a trading range mode now. So and that is near to the second hour's close. So that means market is now moving into 75% chance of sideways and down market. Once towards the end of maybe hour and a half and 2 hours, I start to see this. Okay, so this is my trading range. Bulls did buy there. They wanted to bring market back up. One thing that they failed to do is that they couldn't get back up to the high or the close of bar 18. So if bar 18 was trying to get a breakout, everybody else was actually still long. They're going to take that chance, buy again, and probably break even. Now, this bar has a bear gap. Now, you have 3 bear bars with a bear gap. Even though the bulls actually closed the gap, unfortunately, you have a situation here that market machines see this as a valid bear flag. It's just a very very high pullback. Now, everybody, all the swing traders made money underneath bar 19. Okay, so if you actually measure, they didn't really get a swing trade, but they got more than 5 points. They're actually going for their 10 point. So they're disappointed with the bad follow through and not be able to move underneath the EMA and this pullback. Now they're going to sell up here, just like the bears sold up here. They're going to buy again. So these bears will sell, and the bulls will buy again, but they're not going to be able to get back up here. So to me, what's happening here is exactly what happened here. Anybody who sold underneath 19 couldn't get their 10 points, so they sell again. And bulls who bought here, they know what's going on. These bears are going to sell. They bought here, they're going to exit. Now, not able to get to the bar 18 high or the close is also a big sign that if you bought down here, you need to exit, because these bears sold here, got a 7 point and something, will go for the 10 point, and the bar 31 actually reached the 10 point swing. Okay, so what does this mean? That means I'm looking for more bear flags, because this bear flag, even though it had a very strong reversal back up, it created a double top lower high, wedge top, double top lower high, major trend reversal. I'm looking for a neckline to be taken out. So if I actually draw my price, the only bar that actually took out that neckline is bar 34, but they did it. Even though it's really, really bad, but they did it. So they were able to actually take that out. So to me, this is a bear flag. 1, 2, 3 wedge bottom is bulls buy again. Now the problem here is that now you have a bigger wedge top. Okay, so bulls failed. I did say the bar 29 is your sell zone. I wanted to see a little bit further up. I think it was around 43.25. That was my target, but we did test. Okay, I had a level there with bar 46. We literally tagged it and then start to come down. Now, is when this happens and you have a larger bear flag here, is you're now coming down very strong. It's a vacuum effect. So what is the market doing, right? Well, it wants to sell. Now it sees failure, the 31.37 of a failure, 33.46 is a swing. But you got a very risky 2-bar setup here. But even if you sold underneath 47, your stop goes about 46. This was your, is basically a measured move or 1-to-1 target. Bears really tried their best to get down there. And that was my end of day target, 1553, 1550. We came down to 1675. Let me check something. So they did actually come down to 1550. I think my target was 1525, but I said 1 or 2 tick above 15, you really need to take profit, and that's right there. They actually reached that target, 1550. So, good job, bears. They've done a terrific job. Or you could have measured from here, right? Although you have 2 bars, so that's your 2R, 3R, 4R, right? And then it comes down to 4.5, extends, and then reverses back up. Then I go for 2-bar here, 1R, 2R, 3R. We couldn't really get to the 3.5, but market could be going to the 4R, so we could get a quick breakout here. I don't know how this bar is going to close at the open. I'll leave that there. So the bears, even though it's a risky bar, probably going to pull back, and the bears will sell that pullback, which I said that right here we're going to go back and forth, back and forth. I think I deleted my arrow. Let me get that arrow back. Okay, so I said this area we're going to go back and forth, because this needs to create a channel. You got a spike here, you got a pullback, now you're in a channel. When we pull back, market, the bears are waiting at the high of 48, and then they will sell. And I took profit with 52, but I kept the runner just in case we continue to come down. But we failed, and the lower wick of bar 52 was pretty much the signal that now we're going to pull back. Now, you have a very strong bear gap bar. We had a double top, or low 1, low 2. And the gap is open, so we're going to actually swing. So I sold there, and I was holding a contract. That contract actually made money. I exited out. I didn't sell further, but I did say that this is not good enough for us to reverse back up. 47, 48, and 52 lows are not a good wedge bottom. You're going to have to wait for another push down and break that trend line and trap the sellers and then reverse back. So the reversal signal came in with bar 58. You can buy 1 tick above it, even though it's not an inside bar, but it's really strong close. You are buying against a 3 bear bar micro channel, but it is the third leg down in a way. So maybe complex leg, pullback, second leg, pullback, and a third leg. I found my pullback target for bulls. Right, you can wait. You don't have to buy above 58. You can wait for a pullback and then buy the pullback bar, either with a limit order or stop order. So the target, I said, is going to be from this pullback to that pullback. So you can actually take that. And that was the target. We reached the target, but we couldn't get 2 consecutive bull bars above the trend line. I really hope that we would, so I held my long as I could. I wanted to see if the bulls can actually close this gap and then continue to go back up to these levels. Bulls were buying good bull closes to get their 80% probability to break even if they were stuck up here or there. So they did get their break even, but they could not clear this resistance area. So that's gap right there with bar 47. Unfortunately, it made it difficult, but we held as long as we can. And then I start to say, watch out, if we get 2 consecutive bear bars, bears now will start to measure for their 1R, 2R, so on for their targets. And anyone who bought these 58 or 59, their stops are either here or wider, but they're not going to like it. So is wait for 1-to-1 target or 2-to-1 target, and then you can buy and try to exit. Unfortunately, that became a give-up bar. There was a small head and shoulders pattern form, so I was watching that, and I kept warning everyone, if you're worried, exit out. You can still sell and make money. You should be targeting these lows. Market did come down. It ran some stops and immediately went back up. The strong bulls will buy again, and that was their basically salvaging the trade. So they went back to where they got stuck with 77, and with the close of bar 76, market makers or institutions enter the market. You're going to get a wild ride here because you got a lot of back and forth trading. You got big bars, bad follow-throughs, and market just grinds back up, creates a trading range. So you got a trading range here, you got a trading range at the open, you got a trending trading range here, you got another trading range here. So any move is going to be challenged. And yesterday, we were prone to two-sided trading, and the market just went up again, came back down again. So trading range is trading days or any trading range can be forgiving. If you're stuck somewhere, you should be able to break even and exit out. But no way I'm trading this. I did buy this after exiting my short, and because I was really hoping the market would come down to 53.21 price, but it failed. It failed with a couple of ticks, and when it does that, and it starts to go up, you know you're in the institutional hour, anything goes. All the rules are out the door. So I exited and I bought and I made that money barely back, and I said, I can't do this. This is just too much gambling here. Just step aside and let the market do what it wants to do. And then they sold. Then I start to say, hold. If you're selling, it's going to come down or near 53.15, and it did. Can you guys hang on a minute? Okay, so that's what we ended, and towards the close, market did come down to 53.15.50. So 2 tick or 1 tick, that's normal. But what about today? What can market do? Yesterday we have a really good sell signal bar, and this is basically measured. They got their 1R at the close. If we start to close today at the open, because last couple of hours were bearish, even though it's a trading range trading, I think we need to pull back first at the open, given where we are right now, pre-market 53.23, 53.25. Market will look for some kind of a pullback because this is too low to sell. It's going to probably pull back a little bit, okay? And then it's going to want to sell further down. So my targets and the magnets is going to be 1 hour EMA moving average here, and then April high possibly, and then a deeper pullback, which is not all that deep, but is 23, so 20 to 30 points we can sell into the 2R targets. Let's see. But if we start to become bullish and market wants to sell even higher, I don't think we're going to go all that high. I do have a breakout here. Here is a ledge. We came down. Look at this. Here's why we would pull back at the open. We're already testing above the ledge, right? Ledge comes down, so you would expect to get back above it. At the pre-market, it's sold at 53.23.25, so we're slightly above it. It might go up a little bit. Might be looking for, I don't know, EMA perhaps, and then it come back down. So we'll see how this reacts. But if we start to sell, we know where market can go, and my targets are 1 hour EMA on the hourly chart. We got a bunch of gaps. If the market becomes very, very bearish, I'm gonna look to see if we can get this measured move on the hourly to the downside, possibly there. Or I have levels on the 15-minute chart, the Globex chart. The range is rather tight. So we're probably going to double or triple this range with a breakout. This blue area to the trading range area is my target. This is where I'm going to look for a reversal for bulls. If we start to sell into that, first is I'm going to look for a reversal with double bottom at the Globex low. And then that double bottom pulls back. I'm going to look for some kind of a bear flag, double top, or wedge top bear flag and sell again. That's what I'm looking for. So what the market is doing here is a lower low and a higher high. This is a trap, and the bears can sell. But what I need is this. Down, oops, sorry. Down, up, swing, up, down, up, down. Then we start to make higher lows. I want to see markets go up. Then I'm buying that one back to here again with a couple of legs. So this is what I want for today to do. But hey, I don't know, but this is my plan. So, you know, nobody knows what the future holds. I can only go by, you know, what the market presents. But you always need some kind of a roadmap, a plan of attack, right? Something. So right now you can see we have a bear flag right there. That turned into a much complex, bigger bear flag, 1, 2, and 3 tops. So now this area becomes magnet because selling was rather strong. However, bulls did a cup handle and go up. What about the bulls? Can they actually see this as a complex left shoulder, head, right shoulder, and already breaking out? Yeah, they are, but they're going to have to actually print strong bull bars, get up here. Even if we get up there, the sellers are waiting up there. Okay, so I would be careful. Market can do a quick rush up there only to create some kind of a double top, lower high, and then continue to sell. So if we get a breakout, bullish breakout, market will be looking for a sell zone to sell. This is a gap, not able to close this gap. Okay, there are a ton of bears here. Okay, so but if we can come down here and then find support at the key level and fail to break below it, I'm going to look to buy. So I'm watching this key level. Mid-Asia is an important level. We already breached the top of the Asia, although we are maybe right there. No, we have breached, but the bar hasn't closed. So if we continue to come down, I'm going to look to see how the bulls are holding this area. If we break this area with a bear bar, I'm going to look for a pullback and retest, and I'm going to start to swing down into this area. If it holds, then I'm going to look for buyers. So we have a wedge here, 1 pullback, 2 pullback, 3. The target is this doji low and then that third leg starting point, whether it's the open or the low of that bull bar. Then we're going to bounce, and if we create a left shoulder head and right shoulder and a lower high, then this bear bar and this area is going to be my target, meaning the midnight open, this green price line, 1875 and lower, is going to be my target. All right, so we got about 5 minutes left. Market already reached the key zone, key price level on Globex chart. It could act as a support, or we're going to break it. And this is the ETH hourly. So I want to show you guys something else. Since we have 5 minutes, I want to talk about on the 5 minutes at the open how I trade the open. So I have a 930 bar. I find my 930 bar right there. And before that 930, see that vertical line right there? Okay. I mark the prior highs and prior lows. There's one right there, and then there's one right here. Okay, so what I look for, I can do 2 things. If I really incline to take a trade, I look to see a bear bar. I can put a sell order underneath and quickly sell into that area, into this prior pivot, and take profits. Or I can wait, let the market trap those sellers right there, and then I can buy the reversal. Or here's what I can do is I completely wait for market to show me what it will do at the pivots. It comes down here, gets a rejection, and reverses back. Where is it going to go? It's going to go to that pivot. Okay, if we break that pivot with some kind of a gap bars, wait for market to go up and look for a rejection. You can sell the rejection back to the breakout point, okay, and then look at a gap area and buy that gap area. So then this would be your trade right here. Okay, that's the safest and high probability trade right there, which is a kind of, it takes a forever, but if you're smart about it, some people can't take trades 9 a.m. or 9:30 because that's a staff meeting at work, right? Your boss wants a report of, whatever you did the day before. Maybe you were counting employees and, when they were coming to work, are they on time or tardy? Maybe that's the report that you create, and then you need to talk about it for an hour, right, to your boss. So you missed this, but then you come back to your desk and you did the exercise, and now market is presenting at the gap area, okay, or gap area, right, with a buy order. So you buy and you bank this, and you go to lunch with your colleagues, and you're done for the day. So, but that's one way. Now let's take a look at how many minutes left. Okay, so we have 2 minutes. I'm going to do another exercise. Where is that 9:30 open? 9:30 right there. Here we go. That's the 9:30 bar, right? So here's my pivot right there. That's the pivot. And where's the other pivot? Well, there's this one you can use, but I would use this one. This is the biggest, but this is just way too far away. It's almost like we're not going to get down here. So which one is the magnet then? This one is the magnet, right? So what does market do at the open, right? It goes to that pivot. Are you going to buy that? No. If you buy above this bar or above this bar, yes, you have a great scalp, but you have to take your profit because it can fake you out. So it gets a rejection candle. You can sell underneath that candle. You were targeting the prior pivot levels. Well, that's a decent pivot. You could target that. You can sell into that, take profit. If you hold a runner, you're kind of selling into this huge gap, and you got to already know that there are buyers waiting to stop you. So might as well use these inner structure pivot levels right there, high and lows, and then look what happened there. If you actually use that, market also got a rejection there. That's a failed breakout. That is a failed breakout right there. So what is market doing? Failed and reversed back. That's your rejection candle. Put a buy order right there. Swing, baby, swing. So that's great. Where are you swinging first? Where are you going to take profit? At this level. This is now your new pivot. You're going to take some profit there, right? And then you're going to leave a runner. We broke it. That's great. So now that's your second entry long. Go long. Ooh, that's nice. So at this point, you're adding to your winner. Okay? So let's get back to TH. One thing that I forgot to do is my levels. Oh, the last candle is the low of day also. So we're not so far away from the low of day. Okay, so we are doing the pullback because it's probably too low to sell, so the market is pulling back up, which we already knew that would do. But look what just happened here. The key level is tested and it's still holding. Good for the bulls, but this could create a double top lower high and then some kind of a bear flag on the higher time frame, and it can sell still. Okay, so nobody wants to sell closer to the higher time frame higher time frame moving average because it's just too low. There's not much money to make. It's better to sell the pullback, and we just pulled back to the breakout test area on the hourly breakout test of this bar, that bar. And let's see if we can find sellers. Remember what I said yesterday? If the prior day is bearish, Okay, market can do two things. It can either start to sell at the open, or it needs to back up to the mid and upper third of the bear bar, okay, and then look for sellers and sell. So everything I said since yesterday is happening. Yeah, those staff meetings. Oh man, done it for years, decades. Some were so dry, and some was nothing but goof, 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 and it was just, breakfast time. Some people are at work just so serious. It's just work. You're working for somebody else. Just make life easy and fun. I hate those like stuffy colleagues and who have no sense of humor. All they want to talk is projects. Okay, you're going to get paid at the end of the month. You don't need to be a pain. All right, really, well, it's a doji. It's not really all that wonderful sell signal, bar 1, but it gives you a double top with bar 79. Now bears need to close another bear bar here if they want to get serious and move underneath the close of yesterday and the low of yesterday, which is bar 81. So far, nothing. That's the market double bottom with bar 1. We might need to get 1, 2, 3 wedge top before perhaps selling. We might actually reach the EMA. All right, so we have a doji. Bulls couldn't close above the open of the day, so that puts us slightly bearish. We will become a lot more bearish if we close below bar 81. There's a small gap here. Gaps generally close at the open, but since we're so close to it, let's see if the bears can step it up. They need to close below 1875 on the Globex to continue to sell. If we keep that gap open, then we're going to go right back up to the EMA. So anyone is trailing a sell stop order from under bar 1, they're going to keep it because the bar 1 and 2 are identical lows. We just tested that low, but we've not activated anything. So now we have 3 identical lows. That is, well, it should breach and activate all the sell orders in a second. Okay, it just did. So anyone is selling now underneath bar 1 or 2 is looking for at least a 1-point scalp. If you have sold 1 tick underneath, so you would get filled 1875, market needs to go to 1750 to give you 1 point. That will be 5 ticks. 4 plus 1. And that would be the 1 tick below close of yesterday. So you can see that the bears are going for that 1 point. Our bears made money there by selling. So we had a double top and a lower high, is 79 and bar 1 high and a lower high too. But bears still need to close below the low of yesterday. I think the market wants to test these lows, the Globex low, but we could get a double bottom there. So watch out. If you are selling, and that you should be, you need to pay yourself around here. There's a bit of a bullish gap there. So you're going to get a little bit of hiccup there as bulls are going to try to defend this area. But if we close that gap, we continue to come down. The earliest bounce could be 1 or 2 tick above 53.15. We are going to probably test the 53.15 or 25. 15.25 is there will be a bounce there, but market probably wants to come down further. Now on the ETH, look what happened there, right? So where's that's the 930 bar right there, right? So this is the pivot they target. There's another one right here. Now, if you want to buy, you need a rejection candle. So you have to look for a failed breakout from under the 1650 and look for a rejection candle to buy 1 tick above it. If it actually breaks through it, let it go, let it sell, and then trap the sellers and then reverse. Right? So this is your 930 candle. Then you would mark this also, because if we reverse, that's where we're gonna go. And now you know why we're stalling here. Okay. Today's OPEX. Wow, that's a lot of news. I haven't looked at that chart for some time, but hold on. I'm having some broker data connection issues here. I want to trade, but I can't establish the connection, and I kind of missing a really good price action here. Okay. All right, so we seem to be getting a rejection here. And now you know why that's happening. Right there. So if this bar closes bullish, there will be immediately buy orders above it. We're stuck between the open of the day and the close of the yesterday and low of yesterday. Not a good rejection candle, bar 4, but there are still buy orders start to stack above it. Would I buy? If I do put a buy stop order, probably I may be safe, but I may not get filled. I need another bull bar here. And if we get a nice inside bull bar, those buy orders will be stacked above that bull bar. That will be bar 5. But this bar is still progress and it's new. So we have to wait. Because these rejection candle is not all that great with bar 4. So anyone already bought looking to make a 5-point-ish from the pivot. So they want market to come to here, 525 minimum. And then if they can continue to close bull bars, then they're going to push market up to 24.75, 25.75 area. But failure to get a 5-point, we could pull right back to the low of bar 4. But failure to get a 5-point, we could pull right back to the low of bar 4. So far, bulls are trying to get a 5-point scalp out of this if you measure pivotal from the low. Now, how to become bullish? There's probably a wedge here, maybe 1, 2, 3, but it's not all that great, right? Or you got one, you got nested wedges here, but I like to see one more, trap and go. So here's what happens is market made a new low. Look at this. Market made a new low, right? And then goes up and takes out this high, but not with bull bars. That's not good. Then it comes down and makes another new low. That's not good for the bulls. So you can't really buy. This should have been a little bit high, okay, or a higher low. Now, bulls really need to start to stack bull bars. Even if they did, if they cannot take out that high, we're not going to get a clean reversal. So I don't know how bullish this is. Anyone who put a buy stop order there, hoping that this bar is going to close bullish. Small inverse head and shoulders there with 3, 4, and 5 is we could still go up, but if we don't take out that bar 1 and suddenly close a bear bar, those bears will trap the bulls buying, okay, without a good bull bar and then sell. However, there's a failure swing setup might set up. So what you need to buy, that's why I keep saying I need a second bull bar here. If this bar now closes bullish, I can buy one tick above it with the stop underneath bar 4 and look for a 1R, 2R. That's fine. But if we go to 1R and then start to close strong bear bars, that'll be a trap. Okay? So if you want to buy, you have to still wait for bar 4 to bar 5 to close bullish. Market still sees bar 4 as a rejection candle, and they're trying to reverse. On the RTH, get back to the bar 1 high. On the ETH, they want to get back to not only, well, that is the bar 1, I think. No, wait. Yep, it is. So, or to this high. So, okay, we have an inside bull bar. That's good. Now you have an outside bar 4, inside bar 5. Let's see if the bulls want to buy here with a stop under 5 or 4. That means they have to go and take out the bar 5 high. Closing another bull bar would be ideal. So I don't like it when things are like that. So I don't have a bull close above bar 4. So to me, this is still okay. There will be buy orders above bar 5. But then you're going to have to measure your 1R from here. That's your 1R, that's your 2R. There will be some scalping at the half R, but it could still get up there. Bulls are taking out the bar 5 high, but it's better if they actually close a bull bar here. Not a good setup at all. But they did start to buy. Bears trying to close below bar 3 to continue to sell, but that is the micro left shoulder, inverse left shoulder. As long as it's not breached with a bear bar, bulls are still gonna gun it, and they're gonna try to get to a midpoint right there at the minimum and scalp a little and leave a runner. Minimum. And scalp a little and leave a runner. You guys can see where I'm pointing, right? I mean, it's not an issue anymore. Thank you. It was profit taking yesterday. It's a big bar, a big bull bar, right? So, made a new high, possibly, but we need to start selling. Probably lower third buyers waiting. Waiting for. I think the market is waiting for bar 6 to close because machines think that 10 o'clock is some kind of a news is scheduled. However, we don't have anything scheduled. All the leading indicators, I don't know what that is. E-commerce, retails. Yeah, there's news. 10:15 is the big one. That's Christopher Waller. So I'm going to turn on my voice news on this website that I follow. sideways market at the moment. It would be better if we go up here and make the third wedge top, and then something like that, then sell perhaps. Bears failed here. They saw a double top lower high, but they failed to take out the prior lows, and then they also they failed here. So this is a small grinding up. It's also inside, outside, inside with the prior bar, inside, outside, inside, and bulls did close a bull bar. So the stop underneath here, they're looking to get back to these levels, maybe the inner pivot and then the outer pivot. But it's still very difficult because you got two stuck inside bars within the range of outside bar, which is bar 4, but it's slightly bullish. It just needs to break out. Okay, now we're not all that bullish. We're always in short here because we're underneath EMA, but on a micro level bulls start at the buy. It's just that they're not doing all that great. So I want at least for them to get to the half R, which is 22.75. $22.75 is still target for bulls, but it's only a scalp. The third bull bar, so everybody is buying above it with bar 6 and expecting market to get to the EMA. It's reasonable to buy above 6, and it happens to be right around the half R, but we didn't get a good breakout with bar 6, so that makes things a little bit iffy. And you're kind of buying against this top. Bears want a bear flag and failed follow through buying. But it would be better if we can actually go up somewhere here, maybe even higher. Somewhere in here, in this area. Come on, bears. I mean, bulls. What's taking so long? They want a second entry short like they did here, bar 50 and 55. So they want to trap the buyers, and then keep the gap open like they did here and sell because they got disappointed here. They couldn't sell further. So a similar thing could happen like it happened here. That will be a truncated wedge bear flag. It can happen. So, but those bulls already bought, disappointed. They will buy probably underneath 7 or somewhere down here once again and try to break even. So that's very disappointing. But when you can't get half R, they're forced to buy again and break even. You're always in short, so it's very difficult. And you got a trading range at the open, right? Every other breakout fails. This one failed. This one failed. This one is, I don't know what it's doing. It was supposed to get here. If it's that difficult to get a half R and everybody else is stuck above bar 6, they buy again, maybe a 1-point area underneath 7 and they try to exit out. What happens if they can't? Well, they're going to wait for bears to reach their 10-point target and then buy. And that 10-point area is possibly somewhere around 53.13. So they can allow bears to sell into 53.12 and 13 before buying again, right? So that's a problem. We're closer to the moving average, but it's just too low to sell. Bears trying to close below bar 3. Then they could eliminate the inverse, micro inverse head and shoulders. If they fail for the second time, just the first sell. If the second sell fails, then bulls will take over. But they're trying to defend their stops right now. but this is because we're always in short. If bears actually succeed here, we're going to get a small measured move to the downside, and we could actually reach the 53.13 area. Anyone both, their probably stops are a little bit wide, down somewhere here, most likely around 53.14 area, okay? And if those stops run, we could get a extended move down to the magnet, which is right there. And then another one April high. Disappointing, but it is a bear flag, so they're trying to get a lower high here. So now we're breaching the bar 3 low. They have to still close a bear bar. From the outside bar, inside bar combo, bulls actually reached their first target with a bar 7. But the problem there is that you don't have a solid breakout before then, okay? So the bar 7 compensated as a breakout bar and reaching the target bar. Everybody else started to take profit there, and it quickly escalated further down to the midpoint and to the buy zone, limit buy zone inside the range, okay? So look, if you actually look at all this, right? Look, this bar is a breakout bar, right? But it also took profit there. Went up a little bit, but couldn't close above it, so it's not going to go up to here or nor there or any of these targets. So the profit taking immediately began. You can look for a pullback all the way down here. Look where the buyers show up. You see this red zone? Buyers immediately bought, and they probably already got a break even or gotten close to the break even. So think about it. If you are a bull and you bought above there, right, and you bought somewhere inside here, that right there is your break even. See what happened there? So now what are the bears doing? They're coming down because they want to test the low of bar 4, and they want to get a breakout. But there are buyers waiting at the lower third, okay, all the way down to even here. There are buyers waiting. So we might actually test there and then bounce. So that's 15.25. Or we're just going to accelerate, just like the bulls did with bar 7. We're going to reach the first target and then bounce. But it's most likely they're already trying to trap. But I think it's too late, though, because it's coming into less than 3 minutes to Neil Kashkari, I think, is going to speak somewhere. It's not something interesting. It's not about the economy. I think it's about innovation of payment methods, which is aligned with the news, which is e-commerce. I don't know. But news is news, so I'm sure algos are listening to certain words. So this area is still holding because it's a trap area. Bulls are trying to trap the bears and get a failed second leg, second time selling, and then reverse the market back up once again because they're stuck up here. Although machines bought here very quickly in this area and then bounced, and I kind of proved that how they got their break even. They're still getting their break even, even they're buying lower in the trap zone. So but we close a bear bar, we're going to get a breakout. We're going to test that. We're going to test that. We might even come all the way down to here. Who knows? Because that happens to be closer to the magnet, which is right there. So watch this area. If we break this area with a bear bar this low, we're going to quickly test here. If we get a bull bar, especially close in the midpoint of this bar, 4 and then closing another bull bar, bulls are going to get another breakout, or they will try. So I'm going to get rid of that. You can draw that on your own chart. Here we go. Less than a minute left. I'm sorry, that was Wooler, not Kashgari. Not that it matters, but no, this is the second time bears trying to sell and failing here. Second time bears trying to sell and failing here. First time, second time, but first sell, second sell. Now, if we get a bear close, taking out this right here, we could still get a breakdown. Remember I said pre-market, there's a gap here, a bullish gap. You guys need to pay attention to that right there. So there are probably buyers there. That's the only problem for bears. We have bounced once, bounced twice. If we close a bear bar, we're going to come down and try to close this gap. Closing that gap can bring us to the Globex low and a breach of the Globex low, and we could end up coming down to here. Okay. So watch this area. Right now bulls still buying, but what about they close this gap? Now there's a gap right here. They want to bring the market up there, but they have to close a bull bar above 53.20 and a half first before going there, and then closing another bull bar. Then I would measure for a 1 hour, 2 hour targets. Since we don't have that yet, market can bring us all the way down here once again. So watch that gap area. So anyone both disappointed both, and they got their break even. So if you're a bull, you bought that bar, you bought again somewhere in the lower third of this outside bar. Market gave you twice to get an average price, but obviously it's not enough. Everybody wants to get back to where they bought so they can get the actual break even, which happens to be right there. So if the market actually gets there and closes a bull bar, that could fuel the bulls and we could go higher. But it's very difficult to trade this. It's limit order market. Market sees magnets down here, wants to sell into here. But they're not doing all that great, bears. Bears trapped twice. Bulls trapped twice. So if you got failure over failure, you know, it could finally pick a direction soon. When you have 5 or more reversals at the open, you have a trading range open, right? But you will eventually get a swing setup soon. So you have a tight trading range. So what I do is I count how many bears and bull legs in this, even though it's difficult, but think about it. This is maybe, if this is your tight trading range, this is your maybe a leg 1, leg 2, and leg 3. For bulls, if you count this gap, because we went up, that's your first bull leg, which is terrible. There's no bull bar in there, but assume that this gap is bullish and we went up, so that's your first bull leg. Second bull leg is we're about to make the third bull leg. Then what you do is you find your TR mid-level, tight trading range mid-level, and look for a pullback. And then when you start to get bull bars, you can buy, right? So market is in a tight trading range right now. 5 or more reversals, right? Reversal failed, reversal failed, reversal failed, reversal failed, another one failed. What about the bears? What do they see? Leg 1, leg 2, leg 3. and leg 1, leg 2, leg 3, and if the 50% holds and we get a bear close, they could start the sell, right? Then you have from the open of today, you have a failure. So if we get 2 bull bars, bulls will buy 1 tick above with a stop underneath this, and then they will go for a 1R, 2R, just like they tried to do here, failed. Now they could measure with this right here, a new 1R and 2R. So I don't know how this is going to close, but if it does close like this, you know, there it is. So it's trying to go maybe up here. You don't buy the close, you put a 1 tick above. It's a buy stop order. You don't buy the close. But you can see that the bulls trap the bears just like I said that they would at the low of bar 4. And they're now back to where they entered earlier, so they had a full break even there. So good for them. So now they want to follow through. They could go back to, since their stop was down here, is original target, you can still, it's intact. That's still 1R, okay? They might be still pushing towards where they were going, the half R quick scalp and the 1R up there. And once we start to close, look what's happening here. I said we're probably going to go up here if we cannot come down here. And if we close a bull bar, then those bulls will target these highs. So bulls did a good job safeguarding their stops, trap the bears for the second time. Now they want to swing. So the first target is still 22.75. Got a double top at the EMA with bar 8. Tight trading range highs. You got market went and made a new low and a new high. It came back down, made another new low, but this time it started to make a higher low. So now you have left shoulder, head, right shoulder. And can they finally break out? I think they might be trying to get up to here. What do we need to become more bullish? Well, we need to start closing bull bars above the EMA. We just tested the gap, but the gap is still open. They're trying to close that gap. It's a tight trading range, so market is betting against is strong bull closes and strong bear closes. So it's a very tough situation. You can't expect quick pullbacks. Like I said, if you count this, it's leg 1, leg 2, leg 3. We could quickly come back down and then go up, right? So what I'd like to do is divide the trading range, right? And I look for first leg, second leg, third leg, first leg, second leg. Maybe it comes down like that. This would be the first leg. 1, 2, 3 is for bears. 1, 2, and 3 for bulls and then you got the 50%. So everybody who's buying here, they regret because it could just reverse back to the 50%, and then you look for a buy signal, and then you buy. Then you can take this, clone it up. That will be your first target, and then you might even get a 2-to-1. On the ETH, I did say that if we get a rejection candle, so there's several different ones. Here's the one after 9:30. So they bought it anyway, and then they bought again. Now they're targeting right here 24.50 and then 26. So that's your opening trade. Now here's what can happen is we could go there, come back a little bit, or we're just going to breach through it, go up to this pivot, is breakout, and everybody else is buying. The others, smart traders, will wait for a pullback. They're going to look for a rejection after the breakout. They're going to look for a pullback, and then they will buy. But these are the scalp areas. Okay, so we have closed the gap, but better if the bar actually closes bullish. Then you can look for a follow through. If that bar closes there, just put your stop right there. That's your earliest scalp target right there. And then you're going to look for prior high to be taken out. There might be some hiccups there, but we should get this. So scalp here quickly because it can reverse back down. As soon as it touches, see if they can actually touch. They're really. Oh, they did touch. Oh, wait, I didn't actually measure it right. Sorry, I need to remeasure. That is it. So its target is actually here. It's coming back, but it could use this area as support. We could actually reach right there. This is the target. So I'm measuring from the close of the bar that's actually closed the gap. So that one. And a quick pullback and see if we can actually, market can push through in here. That's their target. And along the way, that's the pivot, also the magnet. So we should be able to reach that. That should not be a problem, but we'll see. That's the half R right there. That should be a scalp. Yelling is speaking right now. Oh, I don't know if she's speaking or maybe start soon. We haven't really got the 1 hour yet. So we have the tight trading range. We're testing its high. It's a quick pullback, but that 1 hour is so close. We're also close to the, this area, the top of the Globex session, and then the first target above. But what about the bears? Looking for remember I had this earlier, wedge top. Well, we haven't really tested it, so we still have room. You also have a impulse pullback, and the last leg. You can even measure your target there. So this is impulse, this is pullback, second pullback, and that's the projected target. Market is trying to get to, see that right there is your target. Trying to get there. So what is that I counted there? What is impulse, pullback, impulse? I'm counting a wedge there, okay? So what I'm doing is this, right? Market sold, first pullback, sold again, second pullback, finally sold again. It could be equal lows, doesn't matter. It's just L's wedge, first leg, second leg, third leg. You can say that the reversal will get us to here. That's one target, okay? But the actual reversal target is from this pullback to that pullback starting point. Ending point, or this leg's starting point. So you just draw your line. First you look for this target to meet. If it doesn't sell, even after second test, if it doesn't sell, look for it to get above and reach there. It didn't sell, look for it to get above and reach there. I don't use 91 bars or 90 bars. You can use this right here. CBOE, US Index Futures, RTH. Wait, where did that go? Right here. That one. That template. Your broker should give you that option. All right, so we reached our 1 hour target. Great job, bulls. But now I'm looking for a follow through into right there. Okay. I mean, I didn't really measure this one right. I should have taken that high. So technically we reached that one, but this one is also the trend line. So I want to see if the bulls can actually reach there. The conjunction of two trend lines. Looking for bulls to get a follow through buying here. We could reach to this level because there were bulls got stuck there yesterday. They're buying low and trying to get back up to here. But I want to see if they can close bull bars above this two dueling lines. So good. I mean, if you were to wait and be patient, there's a trade here, right? So we failed with this first one because you have to wait for several rejections at this point. But I did say, be careful. If we don't get that bear breakout, we're not going to come down here. But if we get it underneath bar 4, then yes, we can sell. But we didn't get it. So it's the second time the bears try to sell. First time, second time, failing, no follow through, no breakout in fact. So you can buy above the bull bars. So here it is, right? So this is the new low. That's high 1, high 2 from the lows. Market is reversing neckline, right? Buyers are above the neckline, regardless how strong bear bar it is. Then you get this extension of a leg. We reached my target. That was the projected bull target. We can push back up more. But here's the thing. If the bulls actually get above this, we're going to get the 2R. 2R is 53.30, 53.26, 26.50 is 1R on from this gap calculation. And I did say that in order to sell this if we're not selling at the open quickly, that means we're going to go to upper third of this bear day, yesterday's high, to look for sellers there, okay? So market is therefore trying to push it higher. But we are right at the midpoint of the body. So let's see. If we cannot get above this, we're not getting up there, right? They're taking profit right now. Back to the EMA. Really nice. 2 great buy signal bars. I mean, be prepared. Market could become very bullish suddenly. If they can find some limit buyers at the EMA and prevent bears from closing below, suddenly we could get a major buy and get back up here. That would give us a measured move to the upside if bulls get serious right around here. We have always and long is already set up down here, and then confirmation with 12 and 13. So now we just need bulls to get above these dueling lines or crossing lines, whatever, call it, and then become serious. Then you can look for first a smaller measured move target. And then as we take out these highs, you can extend your measured move target, which that's what I would do, to there. But something has to happen for something else to happen, and that something hasn't happened, meaning we didn't close a bull bar above where I'm pointing with the arrow. So it's profit taking at the moment. Bears trying to make 3 to 5 points scalp here because they know that the bulls reached around 10-point area. Although I haven't measured, but let me see. Yeah, it is. So they know the bulls are taking profit. They're stuck down underneath bar 8. they're selling there. They're hoping they could get somewhere. If they have sold the close, they're hoping is by selling the close of 13, hoping to get to somewhere safe, which is right there. That's their safety price, meaning average to minimize the losses and exit out. But selling against 1, 2, 3, 4 micro bull channel, that's difficult, isn't it? So if nobody sells here, they're going to have to be forced to sell higher. And in fact, this could break out, and they would be forced to sell up here at the high of the trading range. It really is difficult for bears at the moment, but they have parked their sell stop orders underneath the 14. But the problem here is how bar 15 opened. It opened gapped up. So did nobody actually sell the close of 14? Yeah. So everybody's wondering now, okay, we parked our sell stops underneath 14, but will this bar actually going to sell? It's an inside bar at the top of a small trading range, but bears need another bear bar. And if you measure for retail traders looking to get in underneath bar 14, if they have sold the close or one tick underneath bar 8 and trap, they still desperately need, this is their break-even safety, average break-even price. This could be very difficult for them if they don't get another bear bar here. If you study Al's wedge formations, right? Like there's one right there, right? So look, pay attention to here. This is leg 1, pullback. Is leg 2, pullback. Why? 65 moved underneath is 64. So this is now your leg 3. It's not unique. So what does Al say is when wedge starts to reverse, we're going to go to the third leg starting point. That's your first scalp. So that would be bar 65 low, isn't it? Yeah, we did get there, but it doesn't have to stop there. If we start to get more bear bars, where's the next one which is the starting point of leg 2. And we also got there, right? So the other, I'm finding that this is my first target. I'm looking for a projected target. So here is leg 1 ends, pull back, right? And then leg 2 ends and pull back. From the starting point of the pullback to the ending point of the second pullback, when I'm actually looking for a reversal back down, if the projected target comes before L's first pullback target, which is horizontal, I'm going to take profit there because it could bounce. And it did. Look, it comes down, tested, and bounced. But then we get a close. Okay, that's great. Now we're definitely going to get this one. Now you can leave a runner, and you're going to look for this bar. The high first, and then low. And we just got that. So generally, I take profit there. And if it goes further, that's great. But that's just extension. It probably is going to get exhausted, and it's going to reverse back up. Now I can do the same thing for the other side. I don't need to stop there and just walk away. Now I have another one set up, right? So if you actually look at here on a line chart, so leg 1 pullback, leg 2 pullback, leg 3. So I'm going to get rid of this. That's the pullback, that's the leg, that's the pullback. So from that pullback to that pullback, when market reverses back up, that's my target. This is my target. That's the first, but that's projected target. Horizontal target is that. But if I'm looking at the line chart, now I switch back to the candlestick chart. I can change it a little bit, right? So here we go. So that is leg 1, pull back, leg 2, pull back, leg 3. I'm going to take those highs right there. That's the horizontal. And to this, that right there, that right there. Look, we just reached that target. We couldn't get above it, so this is now obsolete. So, get it? So it's like a two-sided trading. You could catch the price, like you're done selling, and then you could just buy, and you can find your targets. It is known as the Wolfe waves. It is a watered-down version of elite waves. I'm not an elite wave master. I gave my best to it. I'm like, oh, I don't have time for this. I can't deal with it. It's elite waves requires me to use my brain. It's like 200%. I can't do that. It's too complicated. It's just legs inside, another leg, and counting tons. Oh, I even once actually bought an indicator. This was like years ago, and I got suckered into buying the indicator. Well, it was really a trial. Good thing I didn't buy the whole thing. During the trial, I struggled. I said, I don't have time. I'm not a patient person. I need to be able to make my $1,000 and walk away. I cannot deal with this stuff. So there's got to be an easier way. Then I came across, and this time I don't know anything about Al Brooks or his books or content, nothing. I came across Wolfe waves. Okay, I mastered that one. Now I can easily, actually see the legs, 1, 2, 3 legs, and I'm looking for reversal targets. First initial target is the top of the last leg, if it's a bear leg, and then the projected target. So I'm looking for extension of that reversal. Then I studied Brooks' methods, and then I looked at the wedge. I'm like, oh, okay, so this is L's wedge, which I love trading, and basically it's the Wolfe waves. It's very similar, except it's only missing the diagonal, this projected target. So now you learn, you have more tools under your belt to look for extension of the move. Basically, I utilize the wedge reversal a lot. Just helps a lot. So study the wedges, and then let me see if I can, give me a second. See if I can find something for you here. I can't find it right now, so I'm just gonna get about it. See, look what happened. Anybody who put a sell stop order underneath, they didn't get anything. So now they're disappointed. They're now forced to sell even higher, right? So they're not going to get their break even all that quickly. So they're looking for another sell signal bar, and then they will try to get in underneath. But this can just keep go up and up and up. Bulls are trying to extend their profit taking, so they want to get to at least to the 1.5 R, which is right around there. And they see this from the higher time frame. They're still pushing, but we have not closed above 1 R yet, a bull bar, and that's a problem. So bears see that as a weakness, and they're looking for some kind of maybe a wedge. Look, leg 1, pull back. Leg 2, pull back, leg 3. So I'm going to do the whole thing. I'm going to keep this there, or let me delete everything. You can have it on your own chart. So if you have leg 1, pull back, leg 2, pull back. So we need to make a leg 3, right? Leg 3 is basically either it has to go above, or if it's a short leg, right, it could make a double top, right? It's kind of like a truncated. That's where it comes from. Then that means bears are in a hurry to sell. Is this the final leg? When a final leg can't breach that right there, 13 high, or the leg 2 high, that signals me suddenly I start to see bear bars. That signals me that bears are in a rush to sell. So here's the pullback, the top of the pullback to the low of the pullback. That means we can reach there very quickly. And if we break it, right, we can actually come all the way down to first to that high, and we can even breach that. Not doing good with my drum thing here. We can reach there as well, or we can start to sell right from there. But I don't know yet, right? So I have to wait for either a sell signal bar or the bulls to take out that 13 high, extend this leg up, and that's the first thing I anticipate from bulls. If the bulls cannot get it, then that's fine. Then I will anticipate reversal back into this already projected line, right? And your first target is that, because that's where your third leg began, right? Give or take. So we can test there and not make a new low and bounce, that we will be still in a complex third leg and still make a new high. But you can see that if this bar closes like this, we're going to come down there. I'm a chartist, so I'm a technical analyst. I don't care about any fundamentals. And this is one of the reasons why, the biggest reason why I switched to futures. I don't like to trade with fundamentals. Basically, you have to do a lot of research. When I was trying to trade stocks, penny stocks, small caps, whatever, mostly penny. Gosh, I was trying to do all sorts of analysis, and it would turn into like analysis paralysis. And I'm like, I don't know anything about these businesses, who's doing what. I mean, all I know is, this could be all manipulated, pump and dump, and is no matter what analysis I'll have, whether it's good or bad, is I'm going to be manipulated regardless. And when I had my first bag holding with small stocks like that, I was like, these people who are giving me signals, they don't even know what they're doing, and I'm going to be holding a lot of bags if I don't figure this out. And I couldn't figure it out. I was like, this is ridiculous. You can never trade penny stocks trying to be logical. It's completely just manipulated. And I stopped. And I was talking to a couple of colleagues, and they said, and other trader friends, why don't you look into futures? Because if you're looking for consistency, futures could be that, because the basically chart, it just goes on where it left off the next day, the prior day. I said, I don't like that, because there's a story I can tell. And I'm a chartist. My background is graphic design, advertising design, marketing, digital marketing. But it all starts from graphic design. So I love using these tools, and it just made life so easier. I said, oh, now I can see. So I learned a couple of tricks, aka methods, trading methods, and I kept applying. And knowing the fact that I can read the market from prior days and look for continuation, it just makes everything easier. And so I go with what I chart. I don't go with fundamentals. Okay. The only time that I pay attention to fundamentals is when that news is going to come out. That could be a manipulation. Okay. And I try not to trade that hour. So I stay out of it. Otherwise, I will stick to what I see on the chart. Okay. Look what happened there. We're not taking out that low, so that means technically we're still in the third leg, and that third leg can still extend up. But these are still targets for though once we go up, okay, we go up and we start to come down like that. I don't know when that's going to happen. The bulls are not showing me bull bars. It can happen now. It can happen later. It's happening now. Okay. See, no bull bar, 2 bars, 16 and 17, failure, double top, lower high. Everybody's selling, so now you get a quick scalp there. But this area can hold, right? If we break it, then we're going to come down to the high, of bar 8, and we can even extend further down. If there's a gap there, which is right there, we then test this gap is first buyers are in there. But we have to break the 2250. What about not breaking the 2250? Then that's fine. We can still bounce and make a new high. That becomes the complex third leg up still. But you got to understand why things are happening. You got to understand why we're coming down or bouncing and not breaking below. Okay, but this kind of charting will give you that logic and the reasoning. It's not really a unique method, so stop calling that unique. It's the wedge. It's the legs. I'm counting legs, and I'm still in the third leg. As long as the bears won't take out the 13 and 14 lows, we're technically still in the third leg. It's just basically pull back with 2 legs, but it could still continue up. We have a bull flag here, double bottom bull flag at the EMA with bar 12 and bar 18 lows. Around bar 18 market is either made the low of day or high of day, but we could get either a reversal or a breakout. So if we start to close bull bars, we're going to get a breakout. If we start to close below 2250, then expect market to test this gap area. First buyers could be waiting there. Can market be actually creating a bear flag here? Yes. Look, from the lows, that's high 1, high 2, is high 3, high 4. What is high 5? What is high 5? Exactly. No, but what is high 5 though? I didn't say if high 5 is a thing. There's still logic behind that. Yes, macadamian. It's probably a bear flag, isn't it? So it could be a bear flag forming here. And something else is happening here. I want you guys to pay attention. That half R reward is important. Market reached a half R and not able to go beyond that. When you get a half R but you don't get full R, I wonder if we start to close this with bear bodies, okay, then the bears will measure their 1R and 2R because they will be closing this gap, right? So then they will target these lows probably. So, or right there, the open of the bear bar or the lows. If this gap closes, that means bulls are not in it to win it. So we have basically 1, 2, 3 wedged up lower high trend reversal, okay, and we could come down with a huge double top and neckline. Market could come down here and accelerate and sell, and that could be that bear flag on the 5-minute chart. So what do the bears see? If they want to sell, they want to break right there. If they break this with a bear bar, this will be their first scalp, full target, and then they could even go for this. But first, I want to see if there are buyers here. So what could happen here is that, look, 1, 2, we come in here, we bounce, and then we sell again. Or we bounce and go up here and see if there are any sellers there. What about bulls? What if we come down here and suddenly bulls actually start to buy? Yeah, they will buy. So they will buy actually right in the middle. They might actually test right there. So we come in here, I'm going to look for a bounce. If we do bounce here, we're going to go up and test these breakout levels. 2250, maybe that trend line. But then they could start to sell again. But if the buying is very strong, right, then we are going to target these highs and get a breakout. But look what's happening on the Globex. We are closing. Ooh, wow. Okay, so bulls failed. Not interested in that anymore. Now, if the bears need to close a bear bar, they close a bear bar, they will calculate, okay, say that bear bar closed right there. You can put your stop right there. That will be your 1 hour. They're going for it already. But it doesn't really say stop there. They can come in here. I don't know where the body is going to close, so I have to wait for the body to close. All right, we just came to the gap. I want to see a bounce here, even if it's a small. Okay, we're struggling there, but it is given because they just hit a block of buy orders there. So it's natural for it to bounce. I don't know how strong the buy orders are. If they are strong, then we're going to go and test these trend lines, the 2250 and that. If the bulls really show up, we can even take out that high. But if the bulls fail, then we close this gap, we target this low, and then that's your bear flag. So then you look for bears to take out here with a bear body. You want to see a bear close below 100%, and you want market to then come down here. Before it bounces, you take some profit. And then if they close another bear bar, continue to sell into here and further down below. So they're closing the gap now. So that means they're targeting right there. But obviously you don't know, the bar has to close, but you kind of figured that out, right? So that was a failed, bulls couldn't continue their third leg up, that ended up becoming some kind of a truncated wedge, or 1, 2, 3 wedge top, double top, lower high, sell signal 18. We have an 18 bar reversal instead of a breakout. So now market is coming down to here, right? And possibly it's going to take that out. It's going to come into here. Yikes. Okay, bears, we see you. Now look at the gap right here on the Globex. They close that gap. We're going to move into this blue area. We could even go beyond 5,300. 5,300 is now a magnet for bears. There is no high five. That's what we're saying. So if you're counting high five, that's probably a bear flag. So that's the answer I was looking for, but I got it in different parts. So that's what it is. All right. So we just tested the 100%. We didn't really close. You really need to pay yourself there. Just pay yourself. That's fine. Now we go back to that gap that we broke and see if the bears can actually get a follow through selling. But anybody sold here, this is a trading range, they will try to buy above that inside bull bar. If it closes with a very little wick or no wick, they will immediately buy above it. But I don't know how far they're going to go, because I think the bears want to continue down here. But what about the trap? What about here is leg 1, pullback leg 2, pullback leg 3, and a wedge. Can we trap the bears here? We can, but the problem here is that if this bar closes on the Globex below the key level is 2050 to 1875, then the bears will measure, stop above that gap that they closed, entry with the close of the bar. They're going to look for a 1R and 2R and so on. So they're going to target this low and other pivotal lows. Yeah, they're going to target this low and then gaps. So there's a gap here, bull gap. There's another gap. So we could keep, if they get serious, we keep selling into these gaps right there, right here, before bouncing again. But first, they need to close this bar below its midpoint. Then that would be a good setup. But if it closes above its midpoint, then bulls could buy above that inside bar. I don't like to buy above inside bars, even if they close above their midpoints. If they have a really large upper wick, I'm not going to do that. I won't buy above them. Unless we get another bull bar, that's a whole different story. So bears are targeting this right there. So it comes down to percent, fail to close a bear bar. That's bad for the bears. Therefore, they take profit. It just bounces back to where it's sold. And what happened there was, this is a legit bull gap. Many bulls bought there, okay? It was bouncing originally. Initially, it was bouncing. Now, those bulls are stuck. So what do they do? Well, there is the low here, right? Trading range lows. They buy at the trading range lows, and they get back to safety where they bought. If they now exit there, market can continue to sell down. So I'm watching what the bulls are going to do there. But we don't need that anymore, so I'm going to get rid of that. I'll need this. Bulls went back to where they bought and then made a little bit more money. So if they decide to exit now, we can maybe get more bears in the market. What about bulls closing this gap over here? I don't know. It's a strong bar, but I'd rather to wait for it's closed before I say that bears will exit out of the market. But it is disappointing for bears, but you can see that how they failed and why we're getting this inside bar so strong. That is a very good inside bar. There will be buyers one tick above that now. So bears fail to take that out. So this pullback is now extremely strong. There's leg 1 pullback, leg 2 pullback, leg 3 for bears, right? So they park their buy stop orders one tick above 20. But there's a gap here. Other bears are stuck selling. They sell and they try to get the safety. So if you are a bear, if you sold this somehow, or you sold underneath 18, right? And you're stuck there, right? So you're going to sell again. So how do you do that? If you're sold here, you're stuck here, and you sell again, maybe the close of that bar, right? Because it's kind of a trading range now. And they reach the safety. So now bears need to show me, are they done with this? They no longer trust the bears, that this is now a trap, bear flag, second leg trap. Okay, if that's it, then they're not going to be able to close a bear bar underneath that blue line. If they fail to close it, then the bulls will come in. If they do close a bear bar, then we're going to continue and come down to the close of 19, possibly even low of 19. This is a tough morning today. So it's up, it's down, it's up, it's down. It's a two-sided trading. Anybody who bought above this bull bar made money, barely made 5 points. So that means bulls are not able to swing. Anybody is sold underneath this bar expecting a similar move. They got a 5 point, they got more. They're doing a lot better than these bulls. So if they now close this bar on its low, they can easily go for a 10 point. minimum is, and then maybe even 20 point, I don't know. So if that bar closes below its midpoint, those bears could push towards 9 to 10 point target. But they have to eliminate this bar 20. So what do the bears need? They have to close a bar all the way down to the open of bar 20 and then just keep selling. This is not helping them. This bar needs to close further down here in order to sell into here, here, maybe even further down. But you can see how those bears are now, weak bears are exiting. They're like, oh, we're done with this. We're just going to sell that close of bar 20, bet against, because the trading range. We're going to get our break-even safety, and we're done. So now this bar closes like this. All the other bulls waiting above bar 20 will enter the market. And then they will target this gap, and they're going to target these highs, maybe even these highs. So it's tough. It's just a back and forth trading. Now, how many times the market reversed since the open? How many times did we get like a 5 or more reversals here that the swing might be setting up here, right? So let's take a look. I'm going to get rid of this measurement. Here is goes up, reverses 1. It reverses 2nd time. It reverses 3rd time. Reverses 4th time. Reverses the 5th time. Now, can we get a bull reversal? Yeah. So here's what the bull chart move could look like. If the bulls show up here, I'm gonna post that on the Discord. What do we need to go long? You need 2 bull bars. Bulls are looking for 2 consecutive bull bars here to buy above and put a stop underneath either 20 or 19. You got an outside bar followed by an inside bar. So bulls want to go and test the 19 high. Bears are waiting above 19 high, probably. But swing bulls need 2 consecutive bars, and that is 20 and 21. So the other one was, unfortunately, bears couldn't sell, was a failed bull breakout. We had a bull breakout. Did they fail? They might have failed. We could still sell. If the bulls cannot get up here and get a breakout, this could still sell, and this would be the result. Could be the result. So let me show you what I mean. Okay, so 5 or more reversals is we had a breakout, but it kind of failed, right? We did not take out this low. So bulls really need to take out this low. Okay, we get this. Oh, I can't go there. We get this, right? Then we could have another bear flag. We are having that bear flag at the moment. So right here, what we're having is here. So bears can still extend this further down. It's just that they need to hurry up and do it. What about here? Bulls started to reverse this back up, but we moved underneath the EMA once again. They're above the EMA. And that bull breakout actually succeeded. We're not succeeding anything here. We moved underneath the EMA. So here's up on this, down on this, is up on this, down on this, up on this. So you have already a wedge bear flag, 1, 2, 3. If you're not sure, then go to a 3-minute chart and count again. Right? Up on this, down on this. Up, down, up. So you got wedge. Are you still having problem counting? Then go down. The 2-minute chart. I wouldn't go to the 1-minute chart. You should be able to see the pattern, right? Is down, up, down. First leg, pull back. Second leg, pullback, right? So we're now going back up again. But to me, this is up, down, up, or this right here, up and down, up and down, up, final. So where is your target, right? So I'm gonna see if the bears break this trend line, we could finally start to sell. If you have a hard time counting, switch to a smaller time frame. If you have a hard time counting, switch to a smaller time frame. Some bulls bought above and they're trying to make money. They're trying to get back to this high and close the gap, but they may not be able to. So this is a trading range, trading at the moment, right? It's going to break out or down shortly. So what do? Well, you go to Encyclopedia, and I think it's part 15, but let's take a look at it. I'm going to try to get this work. It's just not working the way I want it. Come on. I think it's the Chrome is the problem, so let me close this and open up another browser. We should say that Firefox would work better with Encyclopedia, so I'm going to so far it's an inside day today, but it will change. But it will change. Okay, that works fine. Trading range day. So let me show you what I'm looking at first. Is if you actually go to the encyclopedia, is for a trading range day like this, take a look at the part 15. It is organized in a way: trading range day, late bull breakout, trading range day, failed late bull breakout, bull leg in a trading range, with late bear breakout, and then failed late bear breakout, bear leg in a trading range, so on so. So you also have a midday breakout, right, up or down. That's the one that I was looking for because we're getting closer to the midday. Late bull rally. So we have all sorts. This is a small trading range. You can also take a look at that. And then small trading range, but it gets breakouts with measured moving targets. So all sorts of sections available, and then it goes into trend. It's just a find, but let's take a look at. I was looking at the midday. Okay, so we started underneath, went back above, and then they started to sell. But this is FOMC. So here we go. We started underneath, went back above the EMA, double top. Now we're doing this, except obviously these charts were done a long time ago when price action was a little bit, ATR was so small and you get these kind of small bars, but that's equivalent to what's happening right now. We're underneath the EMA. So it's kind of like a bear flag underneath the EMA. We could be clinging to the EMA, but only to sell. We take this bar 9 lows like they did right here. We can extend it down. And that's where my blue and blue buy zone followed by this trading range area is target. And we can extend this much only to reverse back up in that area. So market could get that 10 point like I marked and then look for a 20 point. Remember, I said it's only 13 points. We could double and triple the Globex session today. So 20 point is there. Heck, we can even go into 30 point and then bounce. Can market go 40 points and sell? I don't think we will. I think we're going to find buyers here. So either 20 points, maybe extra 4 or 5 points, and then finally reverse, or we're going to make a full 30 points and then trap the sellers and reverse. But I'm looking for a 10 point first, because if the bears cannot get their 10 point, then we're definitely not going to get this. That's above. I'm looking for market opening below. So look, it goes up, extends down, and then goes sideways. Bear flag failed, and then we get a midday bull breakout. Let's take a look. Under, above, extending down. It's just a measured move target, okay, of this projected down, and then reverses back up. So the 1 hour EMA is a great place. If we can come down 1 hour EMA, that's about 10 points. Then we start the reverse, okay, then we could say that bear flag failed. We are now getting a bull breakout. But that's a midday swing. So that's around 1:30 p.m. We might actually get this. Who knows? Okay, so we're under, above, down. Well, this could also happen midday. What's happening here? They had a bull flag there. Now, this could be a bull flag, okay? As long as we do not take out these lows, bar 4, bar 9, okay, market then is actually make a bull flag and reverse back up. Look at this one. It started to make higher lows. They started to actually squeeze the bears out of the market, but that happened somewhere around bar 48.50. So I think Brad Wolf is going to have a blast this afternoon. I think he's going to pretty much show us the breakout, and we're just going to suffer until that sets up. So you can see how this is back and forth. So you have to be patient, okay? Look, we're down, up, down, sideways, squeezes. That's a triangle, right? So we're in some kind of a triangle. And it gets really tighter, and then finally we squeeze out, right? Look, leg 1, leg 2, leg 3 for bears. Leg 1, leg 2, small leg 3 for bulls. Find either the apex of the triangle, and that is actually the 50% of your entire trading range, and look to see if the bull bars start to build above it. Then we're going to take out those pivotal highs and get a breakout, okay? If the bars start to move underneath the apex of the triangle or the trading range midpoint, and you start to see bear bars, we're going to take out that pivotal low. Comes down, it goes up, goes sideways, comes down, goes up, goes sideways, tight, and then midday we get a reversal, okay? So I'm sorry, I don't think we're going to have that reversal with me today, but definitely is after the lunch hour with Brad Wolf, we're going to get that up or down. But it looks like it might be wanting to go up again. We'll see. We are always in short at the moment, so I'm not discounting the bears, but bears really need to take out these lows first. If they really want to sell this, that's fine. We need something like this, like gap down from the EMA. We're kind of clinging to the EMA. That's not clinging. Clinging is like literally touching the EMA and going sideways. We have a gap now, small, but it's there. So if we can open that gap underneath the EMA and then keep printing bear bars, then we're going to make that new low. So then this is what I would look for. But then you would get a spike, pullback, channel down with several legs, finally reverses back to the pullback, tries to sell it, fails, finally sells, everybody else exits, and then it just reverses. That's a late breakout. So failed bear breakout, sideways, and a late breakout. So what you need is this, let me get my drawing tool. Here's how I look for reversals, okay? It's actually very simple. Market needs to make a new low. It made a new low. Then if you mark that lower high, if we make a new high, that's great. Don't buy it because we're going to come back and try to test these lows. If these lows fail, meaning we do not take out that low, that means where squeeze begins and we're going to reverse back up, okay? So that's that. So what you need here is this. Raise, pen. You want new low, which we did. We took that out. That's great. That's the high. Got to have that. And then come down. They're not taking out that new low. If we make another higher low and we start to go, I'm going to look for a breakout. If we take out that low, then that's it. I'm going to keep selling the pullbacks. Okay? That's the difference. But what set me up there is this. Market made a new low and then took out that lower high, but not able to get a follow through. So now I'm looking for these lows to be tested. They are. So it's like this. That's it. That sets me up. Now I'm looking for it to come back down. If we don't take that out, that's signal 1, that's signal 2. I'm alerted. Okay, so I know that most likely we're going to now go and take that out. If we take that out, we're going to get a bullish breakout. But if signal number 2 takes that out, you're going to look for a pullback and you're going to sell it. That's a swing short. It's pattern recognition. You'll get there, but you have to go and hunt these patterns to get really used to them. Tight trading range, right? We moved underneath the EMA. We make a higher low. It's kind of a wedge, double bottom. 1, 2, 3. And then we go and take out those lower highs. That's great. Then it comes down. Failed. We're not taking these lows. That's not good. So what do you think the market is going to do? It's signaling you. If we're not coming down to make a new low, then we're going to go and try to take out that high. But did they take out that high with bull bars? No, they didn't. Right? Did they take out that high? No, they didn't. So what are they going to do? It's going to come back down. You're in a trading range. So I'm counting. Strong leg, another strong leg, another strong leg. Here's my 50%. Finally, pull back and sell. But it's really late breakout. But it's there. So, and then for bulls, right, you have maybe 1, 2, and 3 bull legs. And, right, so where are the bull bars to go and take these highs? Nothing. This is a 50% of the trading range. So, bears need to take out this low if they want to get a breakdown. There's a head and shoulders pattern, left shoulder, head, right shoulder, and the bulls are not able to take out those to reverse it back up. So as far as I'm concerned, here's the neckline from 9, 19, and 25. If the bears break this neckline, we will come down. So until that happens, I think you should just be patient and do nothing. Or if you already sold, then you're short, you're looking for a breakdown. You got a magnet here, 1 hour EMA. And check this out. We have this as well. Look. See this? Down, up, down, up, down, up, down, up, right? And then comes down strong, comes down strong, then it does this wedge channel, right? We're still making. So we could actually end up going back up again. If bears cannot break this neckline, we could end up going back up and then sell higher below this high, below that high, somewhere around here. That will get us a really nice 2 legs, another bear flag, but this time it fails and closes at the EMA. Ooh, this is really a tough day. So we have a trading range day in our hands here, and the breakouts could fail. Even if it breaks out, there will be buyers here. If we start to extend the sell, suddenly you're getting these really large bear gap bars, okay? Then expect all of this area to be tested before reversing. So you're going to obviously sell that. You're not going to sit back and do nothing. But remember, we got a magnet here, we got a magnet here. What else do we have? Let's see. I've got a measured move target here, is 98.50. We could pull. I don't think we're going to be selling into 52.79. That's too far away. If we do come down really strongly, I think the latest 52.95 area we might bounce. Okay. So yeah, 95, 98. I think the lower third of this bullish day, buyers are probably waiting. All right, so they're getting their, well, I don't want to say getting their breakout. I don't see it yet. So I really need a bear close. Here is the gap, right? So you can measure it. Bears closed it. If you sold there, you put your stop there. They already got the 1R. Sorry, I figured you guys already figured out how I measure it. That's the 1R. That's the 2R. In fact, or if you put your stop right above is the gap. You want to keep the risk actually small. They reached the 2R, they reached the 3R. They're testing the pivotal lows, but this is their target, so that means they're probably going to go for 5R. Hold on, that's 3, that's 4 right there. That means in the meantime they can try to close this gap. So let's see if they can actually push towards there. Doesn't matter how you measure, it's just you're looking for a follow through. So if you put your stop above that bar and sell the close of the bar with the gap close, then look, we're at the 2R. We could even get to the 3R right there. So on the 5 minutes, I look for impulsive legs, such as this one, and I use Fibonacci extensions. Fibonacci extensions, where's that? There it is. So I measure only the bear leg all the way to 79 because reversal began there. And I go back and connect back to where I started. If I see a bear close, this will be the quick test and scalp. There will be a bounce. But if the bears really mean it, we can then move underneath the 1 hour EMA, and that would be my next target. I'm going to open up the question box and look at it for a couple of questions before I leave because Brad Wolf will join us. Oops. So let me open. All right, question box is open, and I'll take some questions. We broke the neckline barely, but we did. So that's good for the bears. That means what you have here is inverse double cup. Okay, so here's a cup, here's a cup. So extend this cup to downside. So that means you're looking for some kind of a measured move to downside. You can see that this is now becomes the target. I'm doing that haphazardly, but I'm going to measure that. Yeah. It's actually exactly the same, 5307. But I need bears to step it up here. So your first scalp is going to be 127%. But we still don't have a confirmation. Why? Because we still haven't taken out the bar 8 low, I'm sorry, bar 4 low with a bear body. So we don't have a new low, although, wait, we might have. Oh no, we do have a new low, but not with a bear body. With a wick, yes, we have a new low now. And that's good, but I still need a bear body. I need a bear body taking out the 9 and the 4 low. Then we're going to extend super quick, possibly to here. Here, a quick bounce, and then they could sell that one as well. What happens if we don't get the bear body right here? Can we reverse? Yeah, we can reverse because you're in a trading range, and trading range breakouts will fail always. You have leg 1, maybe leg 2, leg 3 for bears. You have leg 1, leg 2, leg 3 for bulls. So mark the 50%. So that's just about open of the day tick price becomes the 50% of this trading range. We could pull right there and then start the sell from there. So you should always expect some kind of a failed breakout if you're not getting that bear breakout with a bear body right now with bar 27. That's how I know that this has a potential of pulling back to open of the day or somewhere near and then sell again. Unless in about 2 minutes this bar closes bearish on its low with a decent bear body, then we will extend further down. So just sit and wait for it to set up. I actually went through that question. So the question is, what strategy or thought process you use to take a scalp is on the 5-minute chart if you don't use a 2 or 3 minutes chart? Well, basically, the thought process is Al Brooks is trading bar by bar reading and methods because Al actually trades the 5-minute chart. He does trade the 2-minute chart, but all of his trading room recorded webinars are on 5 minutes, so we use the 5-minute. Basically, I look for 2 consecutive bear bars or 2 consecutive bull bars before I take any trade is in the direction of the consecutive bars. But really, our minimum scalp is 5 points, but look at the ATR. ATR is 2.8, so there's no such thing 2.8, so that's 2.75, 2.75. So if the market is saying your average move one time is 2.75, you gotta think, are you gonna make a 5 points so quick? What is your scalp here? About 2.5 points, give or take. And if your scalp is 2.5 points, that means there is minimum 2 points in there. How can I expect 5 points? Well, if we're getting a breakout and we're getting a follow through, I can still scalp and hold a runner into 5 points, right? So for example, anyone who actually sold here underneath the EMA, first sell, second sell, they're looking for a 5 point. In order to make 5 point, market actually needs to test 5.25. So everybody sold underneath that bar, looking for market to come down to here. And that's also 2 times the ATR, which is Al's 5-point scalp. But are they going to get it? Where's the bear bar? So what have they scalped so far? So they scalp about 225, right? And then bar closed bearish, right? That could be their runner. They're still holding probably for 525. But you're in a trading range. So what do? We're testing the trading range lows. If you're selling here in the middle of a trading range and you don't want to hold through this because it could be a fake breakout, then you take that 2 point and you're done. You're just in a scalping mode. It's difficult. Where is that bear breakout? Where is the bear breakout with the bear body? It's not there. So it's very difficult. Trading ranges are notorious for going back and forth at the edges. Okay, so you have, this was the trading range originally, right? So that's the 50%. Goes up, failed breakout. It's going to trap you. It did. So it comes down, and we kind of, right, if you measure, right, you didn't really get that target. You only get half R. So now what do? Well, they're going to sell at the high, bring it down, and they're going to trap you again. Look, really nice, strong bear bar. They trapped you. Now it goes up to the 50%. All those traps sold at the 50%. And they're looking at the ATR. They know they could get trapped here once again. So they're just scalping whatever the ATR is giving them. Minimum 2 points, 225. It went more than 225, so they got their scalp. Now, what about the swing? Can they get a 5-point? Well, they didn't. Bar 27 is absolutely a disaster, right? It didn't close bearish enough. So here is, if I actually clean all of this, let me clean. I'm also going to get rid of this indicator that marks the first 6 bars. And now I'm going to absolutely use my trading range. So hold on, just give me a second. Let me get rid of this indicator. Okay, here we go. Right, so you have a trading range, but you don't know any of that. This is the trading range we started with. You can measure the trading range. That's the trading range high, that's the trading range low. We're stuck in it, so I'm going to extend it and extend it, right? Keep extending. We have a breakout. Where is the middle of the trading range? That is the middle of the trading range. I'm literally doing this on another chart. Okay, so now get rid of that. We have a breakout. Are you going to buy that breakout? Those who bought the breakout, right? Maybe 2 bars. Your stop there. I warned you. This is a trading range. That's the half R. If we close above it, we're going to go to the 1 R. We did not close above it. Right? So they failed. Look. They failed right there. Profit taken. They try again. Bulls tried once. They're trying again to get above this. It failed. First sell, second sell. Now where's this going to go? Back to the 50%. Right? So trading range continues. That was the first breakout, failed breakout. Now we come down and test the trading range low. Are you going to sell this and expect a breakout right away? No. So where is the 2 consecutive bear bars? Right there. You put your stop there. You're in a scalp mode. Where are you going to scalp? 1R, 2R. What happens after the 2R? Happens to be price market testing the trading range low. Oh, look, we got a break. We got a reversal right back to the 50%. Right after the 2R test. So that's basically a scalp. You're just done, right? Okay, now what? Well, saga continues. I'm just going to keep extending this trading range as is without changing anything, because market is respecting, price is respecting to the boundaries. In the meantime, I still need a failed breakout from the lows. But in the meantime, I am counting legs. I've got a bull leg. Let's make that green. Okay, bull leg, because we got a gap up, so I'm going to consider that as a bull leg. I got another one, right? But where is the third one? Or is this the second one? And then we have the third one right there. What about the bears? Well, this is the first leg. Here's the second, right? And is this the third? I don't know. It's not. It should start from up here. So this is the second leg. Oh, look, that is the fake out breakout. That's a fake out in the reversing. That's a fake breakout, I should say. So now what? What do we do now? Maybe this was the third leg, and this was the second leg. Here's the first leg. Here's the second leg. Fine. If I am convinced that I have 3 bull legs and 3 bear legs, what now? Well, I'm now looking for bulls to trap the bears trying to sell and reverse it back up to here. What am I going to do there? If I buy this reversal, trap is at the low of a trading range, I'm going to take profit there. You have to take profit there because you don't know if the bulls are going to be able to get above it and go and test right up, right? If that's the case, you take profit, you hold a runner. What if we just go there and suddenly we start to sell? That could happen. But you should always expect failed breakouts. So if you sell the second sell, right? Maybe first sell, second sell, you have a limited scalping area. You just have to scalp here and be done with it. What about bulls? Well, maybe first buy, maybe second buy, and you still have to scalp here. You can't expect market to just do big swings. It's already a tight trading range. I pay attention to the midpoint of the trading range. So you have minimum 2 point scalp there. Anything more is bonus. And in the meantime, count little wedges, right? So here go. 1, pull back, 2, pull back, 3, right? So this is a spike, pull back. This is a spike, pull back, channel down. Where's this going? Right up there. So it's trying to first test the midpoint of the trading range. Probably is going to now get above it because it wants to test here. There might be some sellers there. So what happened? Why are we bouncing here other than, if you're not looking any of these charts, we're bouncing because it's the trading range day, okay? But look at here. If you're using higher time frame, and I found a gap here. I said, market is going to sell. Look, that was the 1R, 2R for bears. Nothing closed below the 2R to continue to 3R. And I said, watch this gap here. We could bounce from this gap. We're in a trading range. Now, there's also something else that's happening here. If this is a bear swing, what do we need from bears? They needed to take out this neckline with a bear body. They didn't. So now we're bouncing, and if there are any sellers somewhere up here, we could continue to sell finally. We could start another swing down. If this is too low to sell at the Globex low, all you're getting is a bounce and looking for sellers to sell. How would that translate to 5-minute chart? 50% of the trading range. Wait, we're going to go up here. If there are any bears wanting to swing this, this would be a good pullback to sell, but you have an outside up bar. That makes things very difficult for bears now. Outside up bar probably going to get a follow through, okay? So now bulls are trying to breach this 50%. So look for that bull breakout bar closing above this black line. And then going and testing here. Then you look for a pullback, you can buy and hold it all the way to up here. If bulls don't want to allow bears to sell, they're going to show you. They're going to show you stacking bull bars above the 50%. If this is nothing but a pullback and then swing down, like here, I'm going to get rid of this because it's getting too busy. So then what are we looking for? We're looking for somewhere here, bulls to fail and bears to start to swing again. how do they invalidate? If they start to close bull bars above the key price level, they're going to target this gap area right here. And if they close this gap area right here, then we're going to have bulls, okay, getting a breakout all the way up here, and then get a breakout from the Globex high. Then we get a swing. We get finally a swing. Now, how do you measure your swing? If this bar closes bullish, look, we have a failed breakout, in fact, twice, right? So are we finally starting a swing? That one of this swing bears failed. Can we buy this? Yes. Wait for this bar to close, then measure, right? Your stop goes there. You're going to buy one tick above. I don't know. Imagine it closed right there. Then that's your 1 hour. You're going to take profit somewhere in the half, leave a runner, expect a pullback, and as the EMA does this, let me get my drilling tool, right? So we go up, we come down, we go up. As the EMA goes like this, you look for a pullback, you look for a nice bull bar, right? And then you buy that, and you're going to target 2R or these highs, which puts us in an even bigger trading range. But so I'm looking for that right now. I didn't sell anything there because you have to always expect, right, bears to fail at the bottom of a trading range. Now, we had a neckline here, right? Here is left shoulder, here is head, and here's right shoulder. Now, if the bulls, how do the bears invalidate? Invalidation of a head and shoulder starts with not able to take out the neckline with bear bars. Then they go and the left shoulder, they start to close, okay? Above here, bull bars, that's pullback, and we go. That's invalidation, and then you can look for some kind of a measured move to the upside as well. Let's target. So it's a lot of charting, but trading range days, they can be problematic. And now I think we might be getting finally bulls getting a leg here up to here. So this could end up becoming a leg. What happens if we just go up and then come back down? Look for traps. If the bulls can trap the bears at and below the EMA, then they're going to squeeze out those bears, and we could even get a much bigger bullish breakout. We could go up there. How about bulls fail? Maybe they get their half R and they fail and they start to sell again. Then you're going to look for bear bars moving underneath the 50% and then finally taking out these lows. Then you would get imbalanced selling. So otherwise, I think we're going to go back to the Globex high again. All right. I'm going to look to see one more question and I'm going to go. I know you weren't expecting this much explanation, but it's a good exercise. Bar 20 is, okay, so the question is, could you talk about how would you manage trade if you bought one tick above bar 20, right? So here is, what do you see here? There's an expanding triangle here, right? Everything aside, so you're seeing some kind of expanding triangle, right? With the apex of the triangle is this trading range midpoint. Is you buy one tick above it. Remember what I said right there is you have a, you have a gap here, and this gap is problem, right? So the bulls failed, bears now taking over. This is a leg in a trading range. It's a really good bar, but I said if anybody bought right there and stuck, they buy again at the bottom of a trading range. They get a break even. So I don't know if the bulls are in it to win it. So if you buy above one tick above 20, you enter 2150. Where does the market go to give you a 1 point, right? But first, let's take a look at the ATR to see if there's a 1 point. ATR was at that time 375. Oh yeah, there's a 1 point in there. You should be able to make a 1 point. So you bought 2150. So it has to go to 2275. 2275 is the low of bar 18. Did market go there? Nope, you failed. So if the market is not going there, why? Because you have a gap. I would not have bought this. You could say this is the gap right here from got into the gap, is they're not even able to take out half the gap. It's failing. You have to exit out of this trade. Your stop is down here with this bar right here. They will sell. Remember right there I said this is probably a wedge top, 1, 2, 3. And I went to the 3-minute chart and the 2-minute chart. I said this is actually a bear flag. I wouldn't buy this. And that's it. It's a trading range day. It's just gonna, it's gonna pull back to the 50%. You don't have to do 50%. You can simply divide it in 3 pieces. And all you have to do, right, this is your trading range right there. Clean this up, right? Showing there. That's a breakout. So you buy in this area, scalp in this area, expect the follow through, but only if bulls close above this level. So that right there is market is alerting you. You're not going to get a follow through to the top of the trading range. We do not have a bull bar closing there. In fact, we closed the bear bar, so we're going to come right back down here. And then we get a fake breakout just like we had here. This time we trap. So best to buy that. Okay. When the gaps are visible, you're buying in the middle of a trading range. It may not go up. It needs to come back down. But this is great. You buy 1 tick above this, right? Or the close of the bar is you're targeting this and this. You don't need to measure 1 hour, 2 hour. You have this now. So you take profit there and then leave a runner. And if the bulls after tagging here close a bull bar, then you're going to target these highs. Okay. But this is a failure of a failure is trap and swing. I would put a buy order above that. Stop there. I would look for a market to get to here and here at the minimum. So it's a trading range trading, is buying low, selling high, taking some profit in the middle just to make sure. And then when it gets there, take full profit. It could go against you, right? Here's the gap right here. We're retesting this gap. This time gap is actually closed with a wick, but that's not actual close. Bulls should have actually closed that bar 31, body somewhere up here. So if you bought above, 1 tick above bar 29 or the close, you made plenty of money there, right? So it went up 325, ATR saying that this is a 325, 3.25 is, oh yeah, look, 3.25. Market gave you 3.25 right there. So what about the bears? This gap is still open. They didn't close it. Wick does not close a gap. It's a good attempt, but it does not close a gap. So everybody who bought above bar 29 or they bought above with confirmation is above bar 30, their stops are here. They're going to buy again, right? 2, 3 bull bars, especially a beautiful open, right? So they will buy probably underneath this bar, and they're going to try to get a break even if they're worried about this bar, right? So if you bought there, you buy again, you're already at the break even. that body pushed up. So this is good for the bulls. However, if this body now closes lower, all the other bulls could exit out, okay? But if this body closes above where I'm pointing, then that's just a pullback, and then we could get another leg up. So what I'm saying is that when something like this sets up and the bulls buy it in the middle of a trading range, you're going to always get these pullbacks. You have to be prepared to buy again, okay? Because I showed you what happened with the upper wick of bar 31. They reached a target there. They reached a target. It's a trading range divided into 3 sections. They reached a target on the mid portion of the upper third trading range. There are always sellers there. This is a buy zone. This is a sell zone. So now those bulls are not stupid. So use L's method, right? Divide it into 3 sections. You're testing in the middle of that third upper section. So bulls are taking profit. It accelerated coming down. But other bulls are like, wait a minute, we bought this. We're looking for a half hour and a 1 hour. So we're not going to let this go. They buy somewhere here, right? And they push it up. If they're worried that this is going to come down now, move underneath the 50% of the trading range, as soon as this bar closes very bearish, they could exit out of there. But I probably wouldn't. So it's a back and forth, back and forth. You have a scalp, not a swing. The only swing you can do in the trading range, buying low and waiting for price to get to the upper third and take profit. So basically you have nothing but scalping. You can get the 1 time the ATR or 1.5. If you can stretch it 2 times, but I don't think you're going to get that. So you're limited. But this is really good for bulls at the moment. So if anybody entered a swing looking for a breakout from this high and price to move further up, then they're measuring with this. They want market to go there or use the Fibonacci retracement. They want market to go here and there and then furthermore up here. It's a midday, but not bar 40. So I don't know if this swing is going to last. So I'm looking at this bar. If this bar closes up high, on its high, more bulls could show up, okay? So then you would even look for, hey, can I get a measured move? You'd be targeting that. This right here is, you failed. I actually told everybody that, I don't think you heard me, there is a gap there. And you can even say, you can take from there to there. There's a gap here. Look, bears close this gap. Now they own the market briefly, right? They closed that gap. There was a gap right there. They closed that gap. So what now? It's moving up. Are you going to buy this? If you buy it, there is now a gap here. You're buying into a gap where the bears own it. They're getting ready to sell it. So here's a first sell. Here's a second sell. It's limited amount of space, but there's a good scalp there. So you should not be buying into that. And I said, if you actually go to a smaller time frame, you are going to be buying a bear flag. Look at the gap down, 2 bars underneath the EMA, always in short. Up, down, up, fail. Look, and you have touching the EMA, low 1, gaps down, low 2, sell. Now you have a double top at the EMA, sell. This is too strong. It's going to look for a bear flag. So I didn't buy that. Anyway, you all have a great weekend. I am done with my session, and Brad Wolf will come in. He's probably waiting for me to leave. So please be safe. What I would do right now, you can measure now, extend your trading range, right? Is find your midpoint, mark it, and see what the bears and the bulls do there. Here is your midpoint. If bears move underneath the EMA, is strong, right? They can actually bring market down, but this is just too much. This right here is always in long setting up, okay? So we're probably going to get a leg 1, leg 2, and a leg 3. So if you're long, I wouldn't exit out of the long just yet, okay? I would look for some kind of a double top above the EMA before selling. So we are right at the 50% of this trading range right there, right? So what will the market do? If bulls start to close bull bars, they're going to want to get up here probably. Or we go up, we make a double top, and then we sell. That means, you see this right here? That's the left shoulder. If we cannot take out that left shoulder with the second try, then we form a double top and we could sell. But if we take out this high, which is the left shoulder, then this is going to be invalidated and market can push up and look for measured move targets. We're going to make a new high and then come back again and then try to buy again. It's a trading range day. All right. Bye everybody.
Tight trading range. And there's a few things. One, so I want to make a few comments. Number one, we're right at yesterday's low. That's going to be an important magnet. The biggest piece is right here. GX is just acronym that I have for Globex. Here's the Globex low. Here's the Globex high. We have not gone above either. The range is 12.75 points for the Globex. The odds are this range is going to get bigger. It's probably going to double. So at a minimum, I expect to break out up or down. So I think there's a 90% chance we're going to either fall below this low or this high. Now we can go sideways for a while. We have a decent bull bar here. Probably going to get a small second leg up. The bulls want to get a breakout above. We've been in a, let me do this here. We've been in a bull channel for the past day and a half. We rallied for one day and rallied a little bit on the open the next day. 50% of the channel, this low to this high, this purple or magenta line is the midpoint. And you can see we're spending a lot of time there. We've sold off for several legs. Chances are this is probably a trend line break and we're going to retest the highs. So what do I think is going to happen? I think we're probably going to rally to this high and eventually try and go back up here. On the daily chart, you have buy the close bar, and it was a disappointment follow-through bar on the next bar. But the reality is there's probably buyers below. Even if we fall below the big bull bar here, I still think there's buyers below. The Bears have a lot of work if they're going to undo this rally. At a minimum, the Bears would need 3 decent bear bars just to probably get a second leg down. Therefore, I think the first reversal down is probably going to be minor. 5-minute chart. We have a lot of overlapping bars. Basically, somewhat of an expanding triangle. More importantly, we're in a tight trading range. Tight trading ranges are always enticing traders to enter at the top and the bottom. The most important thing in a trading range is wait for a clear breakout. Whenever you see 2 or 3 bars up, traders look to buy a pullback to catch the second leg. Give me just a moment here, but this is breakout mode. With the 3 consecutive bull bars, 29, 30, 31, I suspect the bulls will probably get at least a small second leg up, but probabilities very close to 50-50. We would not be doing this if one side clearly had an advantage. Feel free to ask questions in the GoToWebinar chat, and I'll take a look at them here in just a bit. At the moment, I'm waiting. We're neutral, right at the moving average, oscillating back and forth above it and below it. This is not the environment for swing trading. Bears trying to get their downside breakout. Bulls, they'll see this 2 legs down, sell off to 32, pull back with the inside bar 33, and then 34, second leg down 35. The bears, they're trying to keep the market forming lower highs, lower lows. Possible lower high here, possible lower low. We may have to form a wedge. So somewhere over here, bar 79, or you can say bar 4, doesn't really matter. 1, 2, and then maybe 3. That's a possibility. Here's the euro versus the dollar. And you can see we had a few things. I've been talking for a while about this being a possible second leg trap. Leg 1, pull back, leg 2, and leg 2 subdivided into 2 smaller legs. Leg 1, pull back, leg 2. Markets are fractal. Therefore, larger patterns are made up of smaller patterns. So it's really common for one leg to be a wedge bottom and then a bear breakout. Wedge bottom here, bear breakout. And my overall thought was here, we've had a lot of trading range price action. And we had this strong breakout back in mid-April right here. And the follow-through was terrible. Big bear bar, small follow-through bar, big bear bar, overlapping bars. We had a low 1 short here. We tried to form low 2s, but it really wasn't that great. We had too many bull bars in the bull flag. Whenever you get a bull flag or a bear flag, and in this case, let me back up. Whenever you get a bear flag, like what we have here for late April, this rally to the moving average. When the bear flag has a lot of big bull bars in it, it increases the odds that that flag is going to be more of a trading range than the start of a strong, and not lead to a strong second leg. And when you get all this, it increases the chances this is a second leg trap. Big bull bar, you have bears starting to exit below, more bull bars. Then somewhere in here, we've had several attempts down. Bulls started thinking about the possibility of a measured move up to here. And we had a bull breakout bar here. It didn't look strong, but the context was good. Big bull bar, deep pullback testing this breakout point, and then we got the second leg. But you can see right here, we came really close to this measured move target. We're pulling back. What are the chances that this is the high? I think it's pretty low. I think the reality is buy the closed bulls here who buy wide stop, maybe 1 or 2 times the range of this bar down here. They're going to make money. A lot of bulls look at this and say, yeah, it's buy the close, but it's pretty late in a rally that began down here, and it's in the middle of a trading range. So I'm not going to buy the close. I'm going to buy 20% or maybe the midpoint of this bar. And you can see they got filled here. You have disappointed bulls who bought up here scaling in. They're going to decide what they do. If they bought here and scaled in lower, are they going to get out break even on their first with a profit on their second, or are they going to hold? One of the things that traders do is they use higher time frame context, and they use smaller time frames to enter based on higher time frame context. So, for example, you look at this and you're aware here we have a breakout, and the odds are you're going to get a second leg. So some traders, they look at this, and they go to maybe a 60-minute chart, and they start looking for reasons to buy based on the 60-minute because the daily chart supports the 60-minute context. Here, tight bear channel, first reversal up is probably going to fail. So this is probably, as strong as this is, it's probably more minor, and it's probably going to lead to a trading range. Then, what do you see here? Lots of overlapping bars, sideways trading, and then a downside breakout bar. A little bit lower, and now we're starting to go sideways. 2 legs down, leg 1, and then leg 2 subdivided into 2 legs. Traders might look at this and start buying, taking a chance that this is the bottom of the pullback. Other traders, if they're looking at a 60-minute chart here, and they think, yeah, 2 legs down, testing the bottom of this breakout, they might look at a 5-minute chart. Big bear breakout, final flag, bear bar. This is a lower low major trend reversal. But what's really common with major trend reversals is someone said, Brad said heck with the ES and now moved to Forex. Yeah, I think this is a good time to talk about something different for a minute. This is breakout mode. But anyways, we have a lower low major trend reversal. And what's really common, if a major trend reversal is going to work, you're going to get a higher low in this case, or a lower low if it's a major trend reversal for the bears. So here, higher low major trend reversal. So what do traders do? They start buying above bars, betting that you're going to get an upside breakout. Here, big rally, deep pullback, second leg. This was supported based on higher time frame context, and that's the whole point. Traders do that all the time with different time frames. The one thing they should not do, most traders, don't use a 1-minute chart to get a better entry based on a 5-minute. That is rather dangerous. Globex chart, we have a bull bar closing on its high. Some bulls bought it, disappointed by the follow-through bar. And look what happened. They were so disappointed that the next bar rallied near the high of the signal bar and went lower. So we sold off on 32. We went sideways 33, 34. We broke out on 35, and we have an inside bar 36. Now 37 broke below 36. So what leg is this? Who can tell me? Just put it in Discord. What leg is bar 37? Okay, third leg. Third, exactly. It's parabolic because it's a micro channel, but that is a concern for traders. 3 legs down, bottom of a trading range, increases the risk the market could reverse. Am I going to buy? Will traders buy below 36? There's probably buyers below 36. Some traders see it as 2 legs down, sell off 32, pause, second leg down, or 32, pause, 35, pause, 37. But this looks like a trading range, which means probably buyers below, and will probably test back up to somewhere up here. Whenever I see the ES doing this, I become a little bit resistant to trading it. In other words, trading through here, the tight trading range. This range, today's range is really small. You can see it's basically 12.75 points. Yesterday's range, and I'm talking about really the Globex. Yesterday's range was a little more than 30 points. So based on that logic, that makes me think today's range is going to double. We're probably going to get a measured move up or down. Measured move up of today's range, no surprise. It takes you to 36 even, and the high bar 68, you can argue the most recent major lower high, if you don't include this, is 1 tick below it. So we may try and get a measured move up of the range and try and test somewhere up here. But at the moment, I think we're going to go above one of these. There's a 90% chance we will. So low probability that this is the range for the day. Now, low probability does not mean doesn't mean no probability. No probability. I know it's a double negative, but the point is we can stay sideways. This could be the range. We could have a 12-point range, and the ES day only chart would have a less than 10-point range. That'd be a very, very small day. You cannot control the day you have, and so you have to deal with that. This is the chart in front of us. This is what the market is doing. Higher low major trend reversal, left shoulder, trend line break, head, lower low major trend reversal, trend line break to a right shoulder. Bulls want to break out above 31 in the start of a bull trend. But this is the day we have. And you have to respect the market. Therefore, you can't be hoping that the day is going to be something different than what it is. For me, I know the odds are we're going above the red line on the top right. We're going to go below here or above here. Right now, I think we're going to go above here. However, because I think that does not mean I'm expecting that. I'm going to I'm open to that possibility, but I'm not going to be in denial of what the chart is doing. And that is a very, very important thing for one to understand. You can have an opinion about the market, but you must be willing to change your opinion. You can't be married to the trade or your opinion. 60-minute chart. Bull channel, 3 bars down, pause, second leg down, bull bars. Bulls are trying to get the reversal up. What do you notice about this chart? Do you see a problem with these stop entries? Who can tell me in Discord? There's one issue I see with these stop entry buys right here. And other than the big bear bar, second leg down. One of the issues with buying right here is the moving average. Traders look at this and they think, dang, the market came really close to the moving average. Do I really want to buy above a bar here when the moving average is all the way down here? A lot of traders don't do that. Plus, this bar is a surprise, so you expect a second leg. But even here, one of my concerns is if this bar forms a bull bar, one of my concerns is it's going to be just above the moving average. So you can see the moving average, basically 12 and a quarter. If we rally and get a very big bar this hour, that might be enough to drag the moving average up to these lows. But right now, I think the market's going to get closer to the moving average. What about buying above 37? Well, you're buying in the middle of a tight trading range. You can take the buy above 37, put a stop below 37. Now that was talking in 4 minutes ago. Let's talk about the fact that we're 3 minutes into bar 38 and price is not broken above the moving average. So is this stop entry on 37 all that bullish? No. When I think about a stop entry, I'm always thinking about limit order traders. I want limit order traders to get trapped into a bad trade. What I mean by that is this right here. I want to see traders trapped. I want to see bulls buying below a bar, and then bar 2 happens, and all those limit order bulls who bought on the 1 minute chart, buying below here, they have no way to avoid a loss. And that drives the market down quickly. What that does is it entices, if you're a limit order bull and you bought right here, and you see this bar, you're forced to exit the trade and take the loss. And if you're a limit order bull, and then if you're a bear, you're eager to sell. And the reason you're eager to sell is because you look at the market and you think, yeah, this thing's going lower. There's trapped bears, there's trapped bulls, they're trapped into a bad long position, and I'm trapped out of a good short position. Therefore, I need to get short. So both are selling, and you can get a sell off quickly. However, look at this. If you bought above 18.75, the market's at 19 even. So the market is basically one tick above your entry price for the entire time. A good rule of thumb is whenever the market's allowing traders to enter at the same price, bulls who bought above 37 5 minutes ago, now you have new bulls who are allowed to enter at a better price than those. That's a warning that the stop entry there's not a lot of momentum behind the trade. You have some traders who bought above 37, disappointed 38, and they might look to exit above on a retest of the 37 high during 39. 38, bad low 1, probably buyers below. You can call it a low 2. Low 1, pause, low 2, which means we may test down to 36. But 37 is not really a great stop entry. And that makes me concerned if I'm a bull. We still have to think about the possibility of the daily chart getting a strong bear bar, some sort of surprise. Today's Friday. Weekly chart is important. I'm going to look on my other computer. I want to see what the range of the weekly chart is. Midpoint of the week is 91 even. Still a little bit lower. But we could certainly get there. have to go all the way here, and that's pretty far. Probably buyers below 37. Some bulls, they buy above 37 high, they buy more at 37 low, and then they decide what to do at their original entry. Most important thing to remember is that the market's neutral. Until we get a clear breakout up or down, best to assume 50-50. One of the things I do, whenever I have a workspace or a chart and the lows are near the bottom where the time axis is, I always adjust it closer to the middle. If it's at the top, like up here, I always adjust it down closer to the middle. And the reason why I do that is it's more of a psychological thing. It's a reminder that the market can always go lower. If you're right here, if this is the bottom of the screen, it can psychologically make you think that we can't go much lower. So I always like to adjust it to the middle as just a simple reminder that we can get a breakout measured move. I've got a measured move up. We could easily get the measured move down. Right now, looks like we may be instead trying to do this. You can see bulls who bought above the 37, the wedge bottom, 1, 2, 3, the minor reversal, disappointed with 38, giving up on 39. 39 is a surprise, and it may get a small second leg. I want to see how the bar closes, though. For right now, not looking ideal for the bulls. The reason why I want to wait for the bar to close is this right here. Limit order bulls buying below 37, making money. We're still at the bottom of the range, the 27 low, 28 low. Therefore, probably buyers in that general area. Possible failed breakout of a wedge, 1, 2, 3. Fair breakout below that failed, and we're reversing up. You have to be careful when you're trading with limit orders in a tight trading range. And the reason is because when you get the breakout up or down, the breakout can happen really quick. So if we break below 28 or 29, it can race down quickly. If we break above here, it can race up quickly. Traders know it's breakout mode, and therefore they're going to be quick to exit losing shorts or losing longs or shorts depending on how they entered. So this could sell off pretty quick, so you got to be ready. Be ready does not mean be short. It means be ready to see what we get. We're near the 60-minute moving average here, and we're finding buyers. This is not what you want to see. Remember what I talked about earlier with bar 4? 1, 2, 3 pushes down. This might be a failed break. This might be a wedge, and if that's the case, we'll reverse up. So right now, bears, they had an opportunity with 39, but they couldn't get a strong follow-through bar, and that is problematic. You can see we went about a tick below. The Globex low is 13.5, and we went to 1275. So we went 3 ticks below the Globex low, and we reversed up. Is it possible that we fail to break out below the Globex low, and then we reverse up and go to the Globex high? Sure it is. This is pretty common in a trading range where you get a bull bar in the middle of the range right here, and you put the stop below the bar, and you get stopped out only to watch the market reverse back up to the highs. So whenever you're trading in the middle of a trading range, stop placement's difficult, because if you buy here and you put a stop where this line is at the low of this bar, the risk you often get stopped out, and then the market often will reverse back up here. Same thing with if you buy anywhere and you put a stop at the most recent major high or low. If it's a trading range, it often falls below it and then reverses up. And bulls, limit order bulls, they understand that. So what are they doing? They look for these swing points here, and they buy with limit orders at those lows. Or they buy once the market starts to reverse up. So what do you do if 40 closes as a bull bar? I would get out of shorts. To me, this is reversing a lot of the price. We tried to break out below 38, 39. We failed and we're reversing up. This is not what you want to see if you're a bear. And if I'm an always in trader, if I'm short for any reason, I'm probably going to get out above 40. Do I wait for 40 to close? I don't think you have to. Trading ranges, the bars can often grow. And this reversal is so far looking pretty good. Bull bar, decent follow through bar, but let's see what the next bar looks like. In other words, the reason why I pulled up a 1 minute chart is to measure how much of a pullback you get intra-bar. And you can do that with, the more you have experience with price action, the more you get used to being able to imply or infer what a smaller time frame chart will look like based on the formation of the bar. But the formation of a bar is very important. And the reason it's important is this logic here. Limit order bulls buying the low. If this bar goes down and starts to let a lot of limit order bulls out, so it goes down and then pulls back to the entry price, allowing limit order bulls out, or goes down, limit order bulls scale in, and then they're allowed to get out of the trade, that will weaken the probability that it's going to go a lot lower. If instead you get a bull bar that races up really quick, that increases the probability that you're going to go higher. We had that maybe last Friday. Right here. This bar actually looks very not important. However, if you look at this bar on a smaller time frame, this 1 minute bar reversed up. So this bar sold off. And the time of this bar is 12:45 to 12:50. So I believe at 12:58, this bar was on its low and immediately reversed up in 60 seconds. And in 12:59, reversed up and closed above the open of the bar and the close of the prior bar. And that was a sign of urgency on the 1 minute chart. And then on the next bar, you see the low right here, the low of the bar, 38.75, open 38.75. The market immediately went up. So if you're a limit order bear and you sold anywhere, if you're a bear and you sold down here, you quickly got trapped into a losing position. And so that forced traders to cover their shorts. And that's what led to this rally. So whenever I'm trading, I'm always paying attention to that. I want to see traders get trapped. I would definitely get out of shorts above that bar. Too much risk, we're going to go higher. Always in bulls, they can take the buy for a swing. And if you're wondering how you manage it, you buy above it, stop below the bar, and go for a walk. The go for a walk part is kind of it's more of a joke, but you buy above it, put a target, maybe twice the range up, so put a target somewhere up here. Or some traders, they'll look at it like this. If you look, the range of the day is pretty small. Here's the low of the day. There's the high of the day. Maybe I'll set a target somewhere up here. Now, whenever I take a swing trade, what I often do is if I buy above this bar and put a stop below 38, if it's a strong bar with context, I'm willing to give the trade a little bit more time to work out. But if it starts to go sideways for many bars, that's a warning that something's not right here. So if I take the buy, what do I want to see? I want to see a bar like 77 here. That's my entry bar. So let's just pretend for a minute. Let's just say I don't have time to buy this pull up the chart and buy it on like the simulated account. So let's just say we bought it. Let's just keep it simple. And what I'm going to pay attention to, let's just pretend we bought at the market. Our stop's one tick below this bar. So we'll just say stop. If we're long, stop below the bar. Now, why is it a credible long? Because it's probably an always in. It's probably shifting the market's always in long, even though we haven't crossed the moving average yet. So the one thing I'm thinking about here, if I'm long, is I want to see price. I don't want to see price pull back all that much. In other words, if I'm a limit order bear and I sold the high of 40, I don't want the market. If I'm a limit order bear and I sold the high of 40, I'm disappointed so far by this bar, and I might be trying to get out break even at the high of 40. So if I'm a bull, what do I want? I don't want price to get back to the high of 40 and allow those traders out. So not a great entry bar, but will the bar close in the middle of the range? Will it close around above the midpoint? Can it close on its high? That will give us information. The stronger the bar, the more likely we're going to go higher. So we're still hypothetically long. Well, I have an arrow here, and technically the arrow would be, if you want to keep it like how Al marks up his charts, we bought on a stop 1 tick above this bar, stop below. And what I want to see is the follow through. Strong enough at the moment, we'll probably get a second leg. So that's good. Good bar for the bulls. Stop, probably down here. That's a strong enough bar to make me think that we're probably, let me go back to the 15-minute chart here. Strong enough bar to make me think we're probably going to try and test up to here. So remember what I said on the 15-minute chart about this bull bar right here? It's so common for the market to fall below a bull bar or another support level here in a trading range and then immediately find buyers and reverse up. I think we're probably going to try and get to the Globex high. 60-minute chart. The moving average was at 1241. Price went to 1275. So if this bar, if we get a strong reversal here, we're only about 30, less than half a point from this bar touching the moving average. And since this moving average is calculated with every bar, or the close technically, if the close gets all the way up here in the next 30 minutes, that will probably be enough to drag the moving average above this bar. Even though the market didn't touch the moving average real time, traders will look at it as a satisfied touch because this chart will have touched the moving average. Traders will look at it as a satisfied touch because this chart will have touched the moving average. You can see buyers below, probably going to test back up to this high. Not a lot of urgency by the bulls. Good bar on 42, but a little bit disappointing. We're not breaking bar above 41, and that increases the chances maybe we have to pull back to the high of 40. Another bar for the bulls. Body a little bit smaller, but probably buyers below 42, and at least a second leg. Does it matter if you miss the buy above bar 40? No. It never matters where you got in. So whether you bought above 40, whether you bought the low of 39, you bought above 40, you bought above 41, doesn't matter. You're long, and at this point, your risk is from the current price, 53.20, to wherever your stop is, not your entry price to your stop. Bulls trying to get closes above the moving average. They have one close 42. They're trying to get another close 43 above the moving average as a further sign of strength. So far, we're not racing to the upside, and that is disappointing if you're a bull. Someone made a comment, wouldn't it be a good limit order buy if at the high of 40 if price gets back to it? Yeah, it probably would. Now, the question here is if you're a bear, let's say you're a bear and you sold the high of 40, and you're short right now, and 41 and 42 have gone against you. How long are you going to hold the trade? In other words, another way to think about that is how much risk are you willing to incur to try and get out break even? So your loss is from here to here if you're a bear. How much are you, where's your exposure? Are you going to put a stop up here? In other words, are you going to risk $300 to save $50? You're probably not. And so if you're a bull, you have to think about that. If you're a limit order bull and you want to buy a pullback, but you know that the bears aren't getting filled on pullbacks, you know the market's probably going to go higher. Look at this low, 19.5, 19.5, double bottom. It touched the low. So back to this example here. Imagine if you sold the high of this bear bar, then you scaled in maybe a bar or two higher, and then you scaled in on another bar. If you did that, you could be facing a really big losing position rather quickly. So that's what the bears are deciding. This body is getting smaller makes me think we'll probably pull back. I'm just not certain we're going to reach the high of this bar. We could. Bears, I think a lot of bears would get out above 40 or 41 and just take the loss. Bulls, lower low major trend reversal, called a failed breakout below a wedge. Probably going to test up to the high of 31 at a minimum. So that is a logical target. High of 31 is the top of the most recent bear leg. So reasonable for the market to get there. You can see because the bodies are getting smaller, you have bears selling, trying to enter on. You have less traders buying, betting that, and trying to buy a pullback. Because we're in a trading range, we may pull back 50% low of 40, high of this bar. As far as selling here, I would not. 3 legs down, 1, 2, 3. And this rally up to 43 is probably going to get a second leg. Less bulls want to buy up here. Probably going to test down. We may test down to the 41, the 40 high before we get the second leg. But the reality is there's probably buyers below scaling in lower. 45 could not even close below its midpoint, forming a tight trading range with 42, 43, 44, and 45. But consecutive bull bars, 40, 41, those are strong enough bars, we'll probably get a second leg. It's really more than consecutive 2 bull bars, obviously. The point is, this is a tight trading range, and it's probably going to lead to trend resumption because this breakout is strong enough for a second leg. The bears, they're trying to prevent the market from getting above this bar. Now, look at 40 and 41 and ask yourself, do the past 5 bars represent strong bullish price action? Or do you look at it and think, gee, I'm disappointed. Hypothetically, we bought above this bar here, and we're here, but we're going sideways for a lot of bars. So some traders might consider taking partial profits here, or they may be willing to hold, but they're certainly going to be disappointed. This is not doing what traders want. 50% here to here takes you a little under the high of 40. The more we went sideways, the more traders wanted to buy it closer to the 40 high. Not looking good. Because we were going sideways, that is a big enough bar, we may get a small second leg down. So it's a little bit problematic for the bulls. Some bulls might exit here. You're an always in trader. You bought here. Can you exit right here? That's probably okay. This bar is strong enough it may get a second leg down. Plus you're overall on a trading range day. At the moment, I think the bulls are going to be disappointed with this bar. But the bears, they really need to get follow through here. Otherwise, we may just go more sideways. That's the disappointment of a tight trading range. If the bulls were that strong, they shouldn't have allowed that. So it's important to notice we did not go above the 31 high. And to notice We did not go above the 31 high. Why would bulls exit here? Because we may get a small second leg down with 46. And it's possible 47 could be a big bear bar. So if they exit and take the small loss or get out wherever, they can wait to buy again above a bull bar. So why is this bar reversing up? Because you have some traders, some bears who sold the close of 46, and because the market wasn't selling off quickly, they started buying back their shorts. It's still a 50% pullback from the low of 40, high of 45. Pullback from the low of 40, high of 45. But with 46 being as big as it is, makes me think we might get a small second leg down. Testing the breakout point, 45 low. Some bears who sold the close of 46 disappointed with the rally on 47. So when it tests the 46 close again, they may exit. It's basically a double bottom on a smaller time frame. Sell the close of 46. The market pulls back during 47, and when it reaches the close of 46, because it didn't go immediately down, those traders buy back their shorts. Not a great buy for the bulls above 47, so we may go sideways here. We're still in this tight trading range, and that makes it dangerous to be really trading. Middle of the tight trading range, breakout mode, pretty close to 50-50. We still may get a second leg up to from bar 40 and 41. But low probability events are still common in tight trading ranges. So whatever you think is high probability is slightly lower probability in a trading range. Whatever you think is low probability is slightly higher probability. Basically, things become closer and closer to 50%. Bears trying to get a small second leg down after 46. Some traders selling 47, the high of 47. You can see it went down, tested the close of 46, turned up. So you have bears who sold the close of 46 disappointed, getting out, break even. Most important thing, middle of the tight trading range. This is the final hour of the 60-minute chart, final bar. And you can see, because of this right here, it's going to close this as a weaker bull bar. We'll still probably have to trigger the buy above, so I still think we're going to go above the 44 high. But this is disappointing for the bulls. Bulls are trying their best to make the 60-minute bar close as much near its high as possible. So every tick matters. If they can rally in the final minute, somewhere up here, well, you can see they close the bar. So we close with a tail, but chances are probably going to trigger the buy. Bears, they're going to get out above 48 most likely, and some bulls will buy, betting that it's a pullback, and then we'll get the second leg above. Low probability, but not a terrible trade. Terrible trade. So probably going to try and trigger the buy signal bar on the hour, on the prior hour, which is the 44 high. We're not racing up quickly. Some bulls who bought above 48 would be disappointed and might consider exiting. The worst thing you can do here is just take multiple stop entries back and forth. Usually better either wait for the breakout or you buy above a bar like 40, put your stop below, and you hold and see what we get. And or you buy above 48, maybe put a stop below 47, hold and see what we get. Otherwise, probably better just to wait for the breakout. We still might get a small second leg down with 46, and that's what the market's deciding. Is this leg one, deep pullback, leg two, where we'll find buyers, or are we just going to go up? I'm not yet convinced that 46 bears are trapped. This might be a variation of 2 legs up on a smaller time frame. It's hard to see it, but rally, pullback, second leg, or leg one, leg two, leg three, which means we could easily test all the way down, and that's what it looks like is happening. Breakout pullback sell for the bears, probably buyers below, but we still may get a second leg with 46, which means we may fall below 46. So not yet all that clear. Tight trading range, generally it's better to do nothing. Low one, buyers below. Again, limit order market. Tight trading ranges are always limit order markets. And it's very important to not go back and forth. You buy, then you sell below that. You buy above here, you sell below here, then you buy above here. You're going to take a lot of small losses, and by the time you catch the breakout, you will more than likely, at best, break even. Since today's Friday, we can still get some sort of surprise later in the day. So far, the rally looking good. We're close enough on the 60-minute, probably going to trigger it. So let's see what we get. This is the high of the 60-minute on the prior hour. Odds are we're going to at least go one tick above it at a minimum. Bull is trying to get a strong entry bar for the buy above 50, bar 50, top of the trading range. Bears, they want 51 to be a bear bar closing on its low and to trap the bulls into a bad buy. The odds are we're so close to the 44 high, we're probably going to go above it. Bad sell below 51, follow through bar after 50 for the bulls. Probably going to trigger the buy above the red line and go at least a little bit higher. But 51 is a warning. The bulls are not as strong as they could be. If this bar closes on its low, I think bulls could probably get out of longs. It is the middle of the tight trading range, but that's the issue. Middle of the tight trading range, 2 legs up, double top. My one concern here is we are unable to get above lower highs. And if we form a double top here with the bear bar closing on its low, we might trap the bulls into a bad buy and race to the downside. I'm going to go ahead and remove that. You can still be long. Bulls can still be long. But if 52 is a bear bar closing on its low, I think it's okay for bears to exit. I'd probably just get out of longs below that bar. That's fairly disappointing if you are a bear, if you're a bull. So bulls, maybe they have a stop below 60.52. So far it hasn't triggered, and they're trying to prevent the bar from triggering. So you have some bulls buying at the market, putting a stop below 52, taking a chance that the front-running bears who sell the close at 52 instead of below 52, get trapped, and we get a second leg up. You can see the market tested up to the high close 51, pulled back, so now it's forming a micro double top. Again, I still think it's reasonable for the bulls to exit below 52, even though it's in the middle of a tight trading range. This is basically breakout mode. These kind of days can lull you to sleep, as Al would say. And what's important is, even though this is the day, you have to be ready for the breakout. And a lot of times when the range gets really tight and it lasts for a while, the breakout can be really big. I'm going to turn off the screen and see if I can find an example in the encyclopedia. And for those of you well, actually, I've got it right here. Not really the same thing, but similar. Globex market, tight trading range before the start of the U.S. session, and it led to a surprise breakout. This is the day you had 25 consecutive bear bars in a row, and that was May the 2nd, 2023. Now, I'm not expecting this, but the point is, if we're in a tight trading range for a lot of bars, when we do get the breakout, it can be bigger than what seems likely. Here was December 31st, 2009, tight bear channel down, and then a tight trading range, surprise breakout. Al would show this chart pretty regularly, and the point is, obviously this is a New Year's Eve day, but the point is when you're in a tight trading range, you can get a surprise late in the day. This probably won't happen, but you have to be aware of it. Here, we had a bear breakout, sideways, trend resumption, down. Just look at this chart. Tried breaks to the downside, reversed, and we're obviously getting a contracting triangle. So breakout mode, probability 50-50. I get very disinterested in trading when the chart looks like this. Nothing clear yet. Middle of the tight trading range, better to wait. Tight trading range, possible 2 legs down, so better to wait for follow through. Bulls want the second leg trap. 55, a little bit of a surprise, may get a second leg, but bad follow through 56. Bad buy signal bar above 56. Bears trying to get a second leg down, test of the 40 low, but probably buyers below 56. No reason for the bears to exit yet. The bears trying to get the breakout. Second leg down. So far, breakout's looking pretty good. So we have a big bear bar 57, second leg down after 55. What about buying the close at 57, betting on a failed breakout? I'd rather wait and see what the follow. I'd rather wait and see a reversal bar. Strong enough sell-off, we may get a small second leg down, but it's a bear channel. And I have this drawn here because 2 reasons. One, it's a bear channel. That increases the risk that this fails and we get a reversal up. But it's a possible parabolic wedge. So let's see. 40, breakout point low. Let's see if the bears get back to it. 15-minute chart. We broke below the Globex range. I think it's very important that we never went above major lower highs. That increases the chances that we're going to go a little bit lower. But this is the issue. Bottom of a channel, parabolic wedge, in an overall trading range environment. If 58 is the bull bar closing on its high, what do? I think a lot of traders probably get out. Bottom of the channel right here. But the bulls need a decent bull bar closing on its high. Otherwise, we may get a small second leg down. Bear breakout 57, bad follow through 58. which means 59 might be an inside bar or a low one, probably buyers below, and at least a bounce. Bears who sold the close at 57, they might be interested in exiting back at the close at 57. This means we may go sideways for a few bars. Big bear bar, maybe sideways for a few legs, and then try and get another leg down. But my concern, bottom of a channel, which means we could rally to the top of the channel. Bears want to continue to sell off and prevent the bulls from triggering any buy signal bars. You can see the 15-minute chart. Bear breakout, they want a follow-through bar. So we can still go lower. Bad follow-through. We've had bad follow-through after every breakout. Bear bar 55, bad follow-through 56, bear bar 57, bad follow-through 58. Increase the chances we start to go sideways soon, but still always in short. What I mean is, it's basically a parabolic wedge, and that increases the risk that we reverse all the way back here. So this is a little bit problematic for the bears. Not what you want to see. Still a possible failed breakout of a channel, which means we could reverse all the way back up to 53.20. I think it's reasonable for bears to be out of shorts here. Yesterday's low, the blue line, is important, and I suspect we'll probably have a hard time getting far below it or getting far away from it. So I suspect we'll probably get back here before the end of the day. I got rid of the magenta line because it was getting to be a little bit distracting, but this is a reasonable magnet for the bulls or for the market to reach. Bears probably exit above 60. Aggressive bulls can buy, betting on a failed breakout of the tight trading range. It was reasonable to buy above 40. Some bulls bought above 40, and they bought more lower, such as above a bull bar, bar 60. Chances are, probably at least a 60% chance we're going to go back to the 40 high, if not higher than that, and allow the traders who bought here and more lower out with the profit. Probably buyers below 62, and at least a small second leg up, probably going to get back to the blue line. Really disappointing day for breakouts. By the time it's clearly always in short, the market reverses. And same thing for the bulls. By the time it's clearly always in long, the market goes the other way. Even though the rally is disappointing for the bears, excuse me, I get a sip of water. Even though it's disappointing for the bears, the reality is this whole thing is probably more likely a trading range than the start of a strong bull reversal, which means the bears who sold here, scaled in, they're trying to get out, break even. There's really not a lot to say about days like today. Fairly boring. If we're lucky, maybe we get a strong breakout follow through, some kind of measured move up, but more likely going to be something disappointing. So this is the day we have. On days like today, it's really important not to force trades. Otherwise, you'll end up buying high and selling low, taking trades right before there's a breakout, buying the close at 62 when it's really more likely a pullback than the start of a strong reversal. It's easy to recognize that the moves aren't going that far and to try and enter front running the breakout. And that usually causes traders to enter too late. Probably buyers below 63, scaling in lower. You can see bulls bought below 62. Some of them scalped out near the high of the bar. Others will hold, betting on a test of yesterday's low. More bears giving up. Targets yesterday's low, the blue line. We also have the open of the day. That'll be another important magnet. There's the open. Breakout 64. So 65 is an important bar. Will 65 be a big bar closing on its high, increasing the chances we get some kind of measured move up? Maybe the low of 59 to the high of 62, taking us somewhere up here. Or will 65 be a disappointment bar? That is what traders are wondering. I think the reality is we'll probably get to the green line as well, which is the open of the day. Late in the day, but we still have an hour left in the day, and since today's Friday, we can still get a fairly surprising breakout. So it is possible that we get some kind of rally into the close. But if we're going to get that, there's going to be signs. We'll start getting strong bull trend bars closing on their highs with little overlap. Then it will be higher probability to buy. This is looking good for the bulls. Makes me think we're going to get some kind of measured move with 64 or 65. So always in long, and second leg up likely. When the market's breaking out and I can't decide what to do, I trade a 20% position size. So I trade in 20% position size means just a small position. I trade a small position size and just buy something at the market, and when in doubt, put a stop a couple of points below any bull bar and take a chance that the market's going to go higher. And I'm currently long, taking a chance to see what kind of breakout we get. Bull bar, tail above the bar, 66, but probably going to go at least a little bit higher. So that tail is more likely a pullback than the start of a reversal. Bears are hopeful this is 2 legs up, but lots of bull bars, fairly tight rally. That limits the downside potential. Testing the high of 57 and finding buyers. Is there any reason to sell here? I think it's too early to sell. Best case, you're selling what's going to be the start of a trading range. Worst case, you're selling a breakout that can get a measured move. Final hour of the day, and therefore the weekly chart is important. We're right at, so here's the high, all-time high, 22.25, and look where the price is, 22.75, excuse me. March all-time high, which is just this right here. Bulls, they want to get a close above it on the week. So in other words, the bulls want to close above this line. High one buy, breakout pullback buy on 67. There might be sellers above for at least a brief pullback, but look at the 15-minute chart. Do you want to sell right here? That's a pretty strong rally, 64 through 66. And the odds are we're going to get a second leg. This is what I was talking about. 67 got a brief pullback. There were sellers above, and 68 pulled back to the midpoint of 67, but then it closed above the bar. So we're still probably going to go at least a little bit higher. Still too early to be selling. Bears need to do more. We're still within an overall trading range, but we can get a measure move up to here. We get a measure move up at these 3 bull bars, which takes us up here. So there's still targets above. Obviously, the all-time high is important. If anybody has any overall questions or discussions that they want me to talk about, let me know in either Discord or the webinar. But overall, tight channel, trading range. If you're long above either 60 or 64, it's okay to take partial profits. Still may go at least a little bit higher though. Would you have taken any trades earlier in the day? There's limit order trades. So bars like bar 1, bar 2, there's probably buyers below, either below the bar scaling and lower or a distance, maybe an average bar range below the bar. For stop entries, none of these are great. Buying above 11 and then 12, those are good bars, but you're right at the top of the range. Then when you go sideways for several bars, a lot of the bulls who buy above 12 probably get out somewhere in here. Too much risk of reversal down. Certainly they get out below 18. Buying above 20, not a good bar. Big sell-off, probably a second leg down. And I thought the best stop entry was buying above 40, but you can see it just didn't go that far. 40 is one of those bars that when you see it and it rallies, goes sideways, and then you break to the downside, it's reasonable to assume that you're going to go back to the 40 high. That makes buying down here fairly reasonable probability. I'll talk more about trades on the opening range at the end of the day, but lots of limit order trading. And that's because we couldn't break far above the range. We get a big bull bar, and then we go sideways and reverse back down. Big bear bar, bottom of the range, sideways, a little bit lower, and then reversal up. No sign of a top yet. Overlapping bars, but the bears can't even get a bear bar, and that's a sign that the market's always in long and probably going to go higher. However, the dojis, that's a warning. A warning we're in a channel. Bulls trying to get the upside breakout. Good for the bulls. Bears, they want a wedge. 1, 2, 3. It's also testing near getting close to the high close up here. A little bit disappointing on 70. We're getting a breakout and we're immediately pulling back. The bulls want to close above this bull line. That would be a close above the all-time high on the weekly chart. Tail above the bar, so may go sideways fairly soon and have to get closer to the moving average. Too early to sell, but we may have to pull back here. Bulls getting the upside breakout. This is why I mentioned it's too early to be selling. We still may get a measure move up of these bars. Someone asked if do I watch any individual stocks? I pay attention to Apple, and sometimes I'll take trades in those intraday. Generally, and sometimes I'll take trades in the SPY as well. Generally, whenever I'm trading, I'm paying attention to one market. I'm paying attention to one market. Bull bar, but starting to pull back. Disappointment. A warning that bulls used the current bar. They're using the current bar to take profits. Bull bar on 72. However, lots of overlapping bars, probably going to go sideways. Why do I say sideways? Because when you get overlap, that's the start of a channel, and channels evolve into trading ranges. But the bears are unable to get bear bars closing even a one tick bear body. And that's a warning that the bears are not as strong as they could be. I suspect we'll probably have a hard time escaping the blue line, the March all-time high. What about selling below 73? I would not. It's already getting late in the day, and that reduces the probability for doing anything here. Probably reasonable to take profits up here. It's possible we get a surprise breakout and get up to this line, but risk reward is becoming difficult. Risk reward is. So certainly okay just to be flat and waiting for tomorrow. I think it's going to be too difficult to sell. If you sell below a bar, you have bad risk. Your risk is big, and the downside is probably limited, maybe the low of this bar, bar 67. So bad risk reward in a tight bull channel. And if you sell and scale in, you don't have a lot of time left in the day, and therefore you could get trapped. You could sell here, scale in once or twice, and not have enough time for the market to get back to your entry price. That means most traders are better off waiting for Monday. By bar 72, if you haven't made what you wanted to make, you have to ask yourself why you're trading past bar 72. Are you trading because you're doing well and you want to keep the momentum going for the day? Or are you trading because you did bad in here and you're desperate trying to make up the loss? The second one is very, very dangerous. This is what I'm talking about. Bar 73, bear bar, traders buy it. And if you sell the high of 73, we could easily rally somewhere all the way up here before more bears come in. We could also get all the way up here. So I just don't think it's worth selling. I'd either be long or flat. And being flat is more than okay. I'll start the review here in about 10 minutes. And I'll answer questions after the review. Looks like we're going to close above the blue line. Give me just 2 seconds. Oh, on the daily chart, the bears had a sell signal yesterday, and no surprise, they failed to get decent follow through, and instead we're forming a high one buy. Are there more buyers or sellers above the bar? High ones generally pull back and then get trend resumption. So I think there's probably more sellers above the bar. I wouldn't be surprised if we went below it and then maybe had 2 or 3 small legs down and then reversed up to test it. But overall, whatever reversal down we get is likely going to be limited, and we're going to be sideways. 5-minute chart. I mentioned, do it like this. Over the past 2 days, we've been in a fairly tight bull channel, and we tested near 50% around the open and then sold off to basically the bottom of the channel, and we're in a trading range here. So big up, big down, big confusion, probably going to go sideways. And then on the open of today, first bar of the day, we formed a doji. It's a doji bar near the low of yesterday, which is going to be an important magnet for the day. Probably buyers below, scaling in lower. 2, we have an inside bar, micro double top, but inside bars are contracting triangles on smaller time frames, therefore still buyers below and buyers probably at the blue line. And then 3, broke below bar 1 and bar 2, still always in short. Let me back up. 3, we broke below 1, broke below 2, but bottom of a trading range. You can argue always in short, based on yesterday's context and today, but this looks like a trading range more than a bear trend. 4 broke below 81, reversed up. For the bulls, it's a weak buy above, probably going to go sideways. 5 inside bar, triangle, probably buyers below, sellers above. 6, we went outside up just about. We didn't trigger the sell below 5. However, the odds favored buyers below. So you have an inside bar on bar. So you have almost an outside bar on bar 4, but it didn't go above 3. You have an inside bar, bar 5, and then you have an outside up bar on bar 6. This is clearly trading range price action, increases the probability that we're going to have a lot of sideways trading. 7, bull bar, breaking out above 6. But until we break above the moving average, the downside is probably limited. 8, outside down, good for the bears, but again, outside bars, middle of the tight trading range, not ideal. 9, broke below 8, doji, but a bad stop entry buy, probably going to continue to go sideways. And then 10, we had a bull bar, but not a strong bull bar, closing on its high. 11, a breakout, but forcing traders to buy at the 8 high, so not ideal. 12, follow through buying, breakout, follow through, closing above the moving average, good for the bulls, sign of strength for the bulls, increases the probability that we're going to go higher. But what do you notice? We're right at the 1 high. And if you're buying here, you're buying right at resistance, and that's really not ideal. 11 and 12 are strong enough to expect a second leg, but it's overlapping the day's range. So I'm interested to see, what will 13 look like? Will 13 look like another bar like 11 or 12, or will it be disappointing? And no surprise, it's disappointing. 13 spent more time below bar 1 than above bar 1, and that's a sign of weakness for the bulls. 14, bear bar, but probably buyers below. 16, inside bar. We're getting a lot of inside bars today. Inside 14, inside 15, triangle, breakout mode, probably high 1 on 15. So there might be more sellers above 15 than buyers. Bulls buy the close, disappointed, get out, break even. 16, bad entry bar for the bulls who bought above 15. Bears at the second entry sell, implied, but middle of the tight trading range. Targets below, 12 low, the 10 high. 10's a bad stop entry, so reasonable to expect to be retested. The 8 high is a magnet as well. 17 broke below 14 and reversed up. But again, probably sellers above 14. For the bulls, they'll see it as a micro double bottom, 14 and 17. But tight trading range, probably sellers above 17. 18, bear bar closing on its low. I think it's reasonable for traders to get out below this bar. 19, surprise, bear breakout. So we've had 3 bars up, 11, 12, 13, sideways, big bar, 19. This looks like more likely to be a trading range than the start of a strong trend up or down. So clearly in breakout mode, bulls want to measure move up of the 3 bars here, bears want to measure move down. And you can see 20, it's a bull bar. Why did that happen? Bears who sold to close in 19. Bulls who bought below 18 and more lower during 19, they used 20 to sell out of longs. And that's why there were more sellers on the close of bar 20 than buyers. Price went down. Bears who sold here, scaling in on 20, they were so disappointed that a lot of them got out break even on their entire trade back around the midpoint of bar 20. 21, bull bar, closing on its high, probably sellers above and the second leg down. 22, another inside bar. For the bears, it's a breakout pullback sell. For the bulls, they see it as a double bottom with any of these lows. 20, 19 is enough of a surprise that I expect we'll probably get a second leg down. 23, bear breakout below the 4-bar micro channel right here. Bears trying to get trend resumption. 24, retest of the close of bar 20, but tight trading range. I suspect we'll probably at least get a small second leg down. However, 20 through 24 is a problem for the bears. 25, bear breakout, trying to break below yesterday's low. 26 follow through, but a tail below 25, tail below 26. This looks more like a leg than what would become a trading range. 27, doji, probably sellers above. 28, outside down, good for the bears, but an outside bar is typically a trading range bar, and we have 3 overlapping bars here. That will lower the probability of traders selling here. 29, surprise, bull bar, testing back to the apex of this triangle here, good for the bulls. However, big bar, big risk, traders want to see what the next bar will look like. 30, follow through, closing above the moving average, but the moving average is around the midpoint, and 29 is not near as big as 30, so that lowers the probability of traders buying here. 31, 3 consecutive bull bars, but body's getting smaller. 29, 30, 31, plus 31 close below the midpoint, so not really ideal for the bulls. 32, bear breakout, testing the high of 28. For the bears, they'll see it as a 50% pullback from the rally 29, 30, 31. So a lot of bulls, when they see 30 and 31, rather than buying the close, they buy a pullback, betting on a second leg. 33, inside bar, probably buyers below and at least a small second leg up. 34, we tried to trigger the buy above 33. But 32 is enough by surprise. It's probably going to get a second leg down, and that's why 35 happened. 35, 2 legs down, but bottom of a trading range, probably sideways. 36, inside bar. It's an inside bar, probably buyers below, maybe 3 legs down, 1, 2, and 3. And then 37, we found buyers below 36 reversed up. For the bulls, it's an implied wedge, 32, 35, 37. But a bad stop entry, probably buyers, probably sellers above and sideways. 38, bad entry bar for the bulls, increases the probability that we may instead of breaking to the upside, breaks to the downside. The bulls are hopeful this is the head and shoulders bottom, left shoulder, head, right shoulder, but so far we're not getting closes above the moving average. And 39 is a weak signal bar, 37 is. 39, surprise breakout, probably going at least a little bit lower. Good for the bears, but I suspect the downside is probably limited. If we do get a breakout below the 28 low, we could fall pretty quick. 39, you see what happened. We broke below the wedge for 28 and then 40, and then we reversed up sharply. I thought 40 was probably the most reasonable stop and trade of the day. Testing the 60-minute moving average, bull bar closing on its high, failed break out of a wedge here, nested within a larger wedge, 1, 2, 3. Reasonable to assume we're going to get a couple of legs up. Follow through on 41, good for the bulls, probably always in long and buyers below. And then 42, a small bar. 43, overlap. 44, more overlap. We're holding above the moving average, but we're not breaking above these highs. And one of my concerns is we have a lower high, lower low, lower high, lower low. If we form a lower high here, we may get a lower low. 45, bear bar. However, the bulls are not doing enough. Bear bar, so breakout pullback buy at resistance. There might be more sellers above the bar. Sorry about that, I was having to deal with a dog. 46, downside breakout testing the high of 40. Not ideal for the bears. Looks like you have traders giving up here. The bulls, they want a 50% pullback, low of 40 to the high of 45 or 44. So they expect buyers below, but strong enough bar 46, we may get a second leg down. 47, bull bar, but not a great bar for the bulls, increases the probability that there's actually sellers above and we get another leg down. 48, bears who sold to close to 46, disappointed 47. Getting out break even, 46 close, that's why we reversed up. What about buying above 48? You can buy 48, but you're buying in the middle of an overall trading range environment, and that increases the probability that there's actually sellers above and something will be wrong here. The other issue with buying above 48, other than it being in the middle of a breakout mode environment, is We rallied on 47, sold off 48, and rallied 48. So 49 reverses down, it'd be an implied low 2. Sell off, pull back, trend resumption attempt, pull back. If we get another trend resumption attempt, it's a 2-legged pullback on a smaller time frame. And that's what 49 did. 49 sold off but could not close on its low, plus the bar's big, and it's forcing traders to sell low in the 3-bar tight trading range, probably buyers below. 50, outside up, not ideal for the bulls. Probably going to get a second leg up, and probably going to go above one of these lower highs here or here. So good bar for the bulls, outside up though, middle of the trading range, not ideal. Stop entries on a day like today have been terrible, so it's probably, the reality is they're probably going to remain terrible until we get a clear breakout. Weak follow through 51, so a larger second 2 legs, leg 1, pullback, leg 2. Double top was 43 or 44. Weak entry bar for the bulls who bought above 50. Therefore, some of the bulls who bought above 50 might instead sell up here, disappointed by their entry bar, 51. And that's why 52 reversed down, closing on its low. For the bears, I think for the bulls, it's reasonable to get out of shorts if you bought anywhere when you see 52. So get out of shorts, get out of longs below the bar. And then 53, we reversed up, testing the high close, 51.50, and pulled back. Micro double top. And then you can see we triggered the sell below 52 and 54 sideways bar. Middle of the tight trading range, better to really just do nothing. Surprise bar 55, probably going to get at least a second leg down. But then look at the follow through. Disappointment bar 56, strong enough bar to expect lower prices. 57, and let me back up. Why was this a strong enough bar to expect lower prices? Because this is not a good buy signal bar. The bulls, most of the bulls use the rally on this current bar to exit longs rather than establish new longs. And bears who sold and scaled in are expecting at least a second leg down. Plus, we'll probably fall below the 40 low. Why would we fall below the 40 low? Because that's really common in a trading range day. Trading ranges, it's really common to fall below obvious support levels like the 40 low, break below it by a couple of ticks, and then reverse back up. Surprise 57, breaking out below the bars to the left. Good for the bulls, but possible failed breakout below the bottom of the channel. Plus, we're at support, one support level, this low right here from yesterday, the start of the channel. And 55, big bear bar, 56, bad follow through, 57, another bar, and then 58, 59, bad follow through selling for the bears. For the bears, parabolic wedge, 1, 2, 3, probably going to get a reversal up on 60. 60, bull bar closing on its high. I think at this point, we're probably going to test back up to 30 to the 40 high. So at this point, really not ideal. It's really not ideal for bears to be short. The reality is this looks more like a failed breakout than the start of a new bear trend. So 60% chance at a minimum, we're probably going back to the high of 40. Why? Because 40 is a reasonable stop entry. And whenever you get a reasonable stop entry in a trading range, usually the market will retest it. Same thing with bar 20. It's not a good stop entry for the bulls, but it's reasonable to buy it. And if you do buy it and you scale in lower, you're probably going to make money. 61, bad entry bar for the bulls, but breakout pullback sell for the bears, probably buyers below and at least a second leg up. 62, bull bar closing on its high. For the bulls, they're hopeful it's a 3-bar micro channel that will lead to buyers below and higher prices. The bears, they see it as an implied 2 legs up, rally, pullback, second leg. The bottom of a trading range at near this failed breakout, probably going to go higher and test up to the 40 high. 63, bear bar closing on its low, probably more of a buy the close bar than a sell the close bar. 64, possible bull breakout above the bear flag. Let me fix these lines really quick. Possible bull breakout of the bear flag with 64. Strong enough bar, probably going to go higher, always in long. Good follow through 65. at a minimum, I think we're probably going to get a measure move up of these two bars, which takes us up to this high right here. So probably going to the blue line. 66, 3 consecutive bull bars, but a tail above. We'll probably pull back fairly soon, but strong enough. First reversal down is likely to be minor. And you can see we pretty much drifted sideways to up for the rest of the day. Whenever you get these overlapping bars with sideways, that increases the chances that the market's in a trading range. 1 second. Whenever you get these overlapping bars, it increases the probability that the market is going to go more sideways to up. The most important thing here is whenever the market is in a tight bull channel, even though you think you're at the top of a trading range, when you start getting a lot of dojis and overlapping bars, it's really important to not be selling. Don't sell until you see a clear trend line break. And you can see what happened. We got a trend line break here to 47. We tested the moving average, and then we rallied to a new high. And that is very common in trading ranges. For stop entries, really not a great stop entry market for the day. And that's because we were in a tight trading range for the majority of the day. Whenever you're in a tight trading range, it's really hard for the market to change the characteristics. Bear breakout, but it gets bad follow through on the way down. It increases the risk that the breakout's going to fail and retest the trading range. Reason for that is you have a lot of limit order bulls buying below bars, and the odds are they're going to make money if they scale in lower. Stop entries, you can buy above 11, but top of the trading range, not ideal. If you're long anywhere up here, and I'm really talking about always in, bulls that are long, they have to get out. I think they get out below 18 or a point or two below 18. And where do you sell? I would not sell below 19. Bottom third of the trading range and probably going to get a pullback. And then the first sell, really tough. I wouldn't sell below 22. I think selling below 24, not ideal. And a lot of traders, unless you're selling above bars, it's really hard to get short here. Bulls, bears that are short, they probably get out a point or two above, either a point or two above 28 or on the high of 29. Bulls they can buy, but what do you do with this? If you're long and then you see the rally up here and it starts to go sideways, it's usually best to exit the trade. Trading ranges are notorious for forcing you to buy in the middle of the range and then pulling back to below the low of the breakout and then getting trend resumption. Bears, really no decent stoppage. I thought the reality is the most decent stop entry of the day was probably R40. Midday possible reversal. You can buy above 40. It's a decent bull bar. However, even 40, when you see 41, that's good for the bulls. But then you got 42 through 45. A lot of traders will start reducing their position and making them and really waiting for another stop entry. And then here, really a mess. If you buy above this bar, it's really not great. And a lot of bulls, if they're buying in trading ranges, they're front-running breakouts. That's basically what buying on a stop entry is. You're trying to catch the breakout and when you're in a trading range, you're trying to catch the breakout before it forms. A lot of traders, when they do that, they will exit rather quickly. So if you look at 48 on market replay, the close of 48, open of 49, you'll notice that it actually took 3 or 4 minutes to actually go down here. In other words, if you bought the 48 high, you had a minute or two to exit the trade when the market wasn't going your way. And a lot of traders do that. I do that pretty regularly. 51, bull bar, if you bought it, you had an entire bar to decide whether or not you should get out around break even. But really not great stop entries here. I think always in bulls get out below 52. I don't know if the bear's short, still tough. You can, taking a chance at the double top and we break below the neckline, and you can see we came close, didn't quite get there. Always in short with 55, you can sell below it, or 56, strong enough bar, second leg down likely, but really tough to sell 57. Why is it tough to sell 57? It's tough to sell 57 because 55 is a big bar and it had bad follow through 58, and moves typically get weaker as they progress. This is the likely second leg down. Therefore, it should be weaker than the first leg, which means 58 should probably have bad follow through. And that's why a lot of traders bought the close at 59 and we reversed. Bulls, they buy above 60, bears get out. They can buy above 64 or 65 if they want higher probability. And then where do they get out? They probably get out. They can get out below any of these bars, or they just get out below 76. Or excuse me, 79 and call it a day. Really disappointing price action. If you're a limit order trader and you're willing to do the work, you're willing to buy below, scaling lower, sell above, scaling higher, you can do really, really well on a day like today. But for most traders, it's really not all that ideal. Limit orders, buy below 1, scaling lower, and just pick a bar. What's interesting about today, almost any bar, there's pretty much every bar except for these over here. You could have done the opposite of the bar. So if it's a bear bar, you could have bought it. If it's a bull bar, you could have sold it, and you would have made money. A lot of traders, me included, what I do is I don't want to sell the first leg up. So if I see a big bar like 11, I'm not selling here. I'll wait for a trend line break and then sell above a bar like 16, 15, 16, or 17. Big bear bar here. I'm not eager to fade this bar, strong enough bar, another leg down. But once we get the second leg, either here or here, I'm a lot more willing to buy, betting on a pullback. Same thing here. Big rally, I'm not willing to sell that. But once we get the trend line break and maybe a retest, I'm more willing to sell. But pretty much anywhere, you could have bought below, especially if it was second, third legs, scaled in lower, made money. The biggest thing with today is to just not be in a rush. Whenever you see a lot of disappointing bars and it's hard to find the always in direction, you're in a trading range. So it's important to trade it like a trading range, buy low, sell high, and scalp. Let me buy the close, sell the close. All of these were really opposites. Big bull bar, big bear bar, better to sell it. Consecutive bull bars, you can buy it, but expect to be disappointed within a few bars. Same thing here. If you sell this, expect to be disappointed within a bar or two. Big bull bar, follow through, expect disappointment within a few bars. Trading ranges are always closing gaps. And in order to close a gap, you have to have disappointing follow through because that's what allows traders out of the trade. Bulls buy up here, they get trapped on 19, they don't panic, and the disappointment allows them out of the trade. Bears sell here, they scale in, they don't panic out of their shorts, and this bar allows them out of the trade. That happens over and over. Bulls buy the 54 low, they don't panic here or on 57, they buy more above the bull bar, and the market allows them out of the trade. But really, maybe sell the close 55 or 56, not ideal. I thought the most reasonable buy and sell the close at the end of the day. You could probably buy 41, that's probably an okay buy the close bar. You could buy, I thought, 65 or 66 or a pullback to 66. All of that was buy the close for at least a few bars. Let me take a look at questions. Okay, question. When traders buy the close of a bar like 73 here, are they putting a stop below? Okay, so when traders buy the close of a bar like 73, are they putting a stop below? Just saying, if so, they made 2 times their initial risk. I'm not sure of what you were saying, but for me, had I bought the close of 73, which I did not, I'm not putting a stop 1 tick below. The way I look at that trade is this. 73 is a high one, and it's a bad sell. It's more likely to trigger above than to go that far below. But buying really in the middle of the bar is really not ideal. Okay, question. Hi, Brad. I always struggle between choosing wide stops, a wide stop loss that makes sense, and sticking to proper risk reward. Could you talk about your thoughts on that, please? Yeah, let me pull up this spreadsheet. So here, I don't know if I've ever talked about this. So I have a spreadsheet that's just got kind of a couple of basically examples of things. This, some of you have seen this, some of you haven't. There's nothing special about this spreadsheet. What this spreadsheet is, it's an example of just the power of compounding. And again, this is, kind of a disclaimer here. This is strictly about what happens when you compound a number. And what it is here's a balance, here's a profit, and here's what you make per day. So the whole point with it is you took $10,000 and someone can make 10% in a month. Why 10%? Well, and I want to be a little careful about what I say, but the point is 10%, make 10%, and if you can trade 15 days out of the month, so you basically 15 trading days and you break even or don't trade the other 5 days, you got to make 66 basis points a day. So in other words, 0.0067 is what you have to make. If you take 4 trades a day, you have to make 17 basis points, 0.0017 in a day. And that means if you think about your risk, even if a trader can get, let's say a trader can get half their risk, which they should get more than that, but let's say they could. All they have to do, they can basically risk 34 basis points a trade, assuming they have a good system. And a good system is one that's a high winning percentage trading style. But if they risk 34 basis points per trade, in other words, that's about a little more than 0.3 of 1%. That is if it's a good system, the risk of ruin is extremely small. So why am I bringing this up? A lot of traders think that they have to make 3% in a day. And, it's not a dig on prop firms or anything like that, but one of the reasons I made this spreadsheet is to explain that if one can just make something reasonable every day, doesn't even have to be 1% a day. It can be 0.5%. If they can do that every day for a long period of time, the power of compounding interest, compounding is going to greatly benefit them. You don't need to make, if you're making 4-5% a day, guess what's going to happen? Most people, unless they're really, really aggressive and can take a very large number of trades, if they're doing that, the volatility of their performance is going to be dramatic. In other words, they're going to have one day they make 4 or 5%. Then they're going to have another day they make 3%. Then they're going to have another day where they lose 5%. So if you have big swings up and down, that's not ideal. But if you're trading really small, you can gradually increase in account balance. Obviously, there's a fallacy to this example. That fallacy is because it's assuming one can increase basically their risk 10% every month without deviating, and that is unlikely. But back to the question, I have trouble knowing when to use a wide stop in swing trading. When to use a wide stop and when not to. So here's the problem with wide stops. Wide stops require, so let's do 0.5 R, 1 R, and 2 R. So what is this? 0.5 R would simply be 0.5 times 1, and let's say you're 75% profitable. Let's do 80%. 1 R is 1 to 1. You're 1 to 1, you're risking $1 to make $1, and you're 60% profitable. 2 R is this right here. You're 40% profitable, making twice your risk. So let's think about this example for a minute. Most people, they understand logically, if they use a wide stop, they can have a higher probability of making money, and that's true. The benefit is you have a higher probability of making money. The problem is you have to know when that high probability exists. In order to make anything above these is bad risk reward. So both of these are bad risk reward. These are bad risk reward trades. down here, great risk reward. Anything where you have 1R or less is a bad risk reward. And you're only doing that to gain if the probability is high enough to offset it. So what traders do, they initially take a trade, and let's say the probability is 70%. What happens is they're too quick to exit. They're too slow to exit. They sell the close of this bar, they sell the pullback of this bar, and they have a high probability of getting another leg down. So if they sell this close, odds are it's going to go a little bit lower. But what they end up doing is they end up selling, even here, big bar. High probability, it'll at least go lower, or you can avoid a loss. But what they do, they put a stop up here. They sell the close of this bar, stop up here, and they hold all the way up. And what happens is this right here. You have a big bar, probability is 70% that there's at least sellers above initially, and we'll test the close. I'm making up the number. Is it 70%, 60%? It doesn't matter. But it's probably going to go sideways first. At some point, bar 60, it's no longer 70%. It might be 55%. Then 70, 61, 52%. And by the way, point 2 is the minimum return needed to basically, it's kind of like minimum wage, minimum return needed to make a profit and not lose money in the account. Here, 52%, at some point, the probability gets to 51, and then before you know it, 49. And when 49 happens, you get this, a sudden reversal with follow through. So what traders do all the time, they buy rallies, but they just cannot exit the trade. And so they don't understand that if they buy up here and put a stop down here, odds are high that they can add on and get out break even at their first entry. But if they hold forever, the probability changes. Buying, and that's anywhere. Big bar, high probability, it's at least going to go sideways for a bar or two. And even here, if you scale in higher, high probability you're going to make a second leg down. Here, high probability if you sell, stop above, you're going to make money. But eventually, it starts to transition into the opposite direction. So the point I'm making is this. You have to decide what is easier for you to achieve. And that I have not even said anything about half an R. Your reward is 0.5, your risk is 1. You need an 80% probability, 80% profitability factor to break even. It's the same result as this. Versus, look at this down here. If you can go for twice your risk and be 40% profitable, you're going to meet the same as this, which means you really need to be 70% profitable at a minimum at 1-to-1 to make it worthwhile. Here, if you can just get to 45%, you're already close to this number. If you can get to 47%, you're already above the number. Most of the time, the market's 50-50. So this down here is going to be much easier to achieve for most traders. So that's what I would focus on. We had a question, would you consider buying on a stop above bar 10 here, given the tails below the bar, assuming there's buying pressure in overall triangle? I think it's okay to buy above a bar like 10. Low probability, but second failed breakout of yesterday's low. You can buy it, taking a chance to get an opening reversal. 2 legs down on the open. I don't have a problem with that. In trading ranges, buy signal bars always look worse than they normally are. Question, you said buy stop bars like get retested, such as bar 40 here. Why is that? Yeah, whenever you take a reasonable trade, usually the market will allow you out of the trade or at least retest it, especially in a trading range. And the reason is trading ranges are channels. So traders who, you have to look at it like this. Traders who sell anywhere in here and scale in higher, they're going to more than likely be able to avoid a loss. Most of the time the market's in a channel or a trading range. And channels are the Channels are transition points between trends and trading ranges. Here we have a spike and channel. That channel from here to here evolves into a trading range. And now we call this whole thing a trading range from here all the way down to here. But at this point, you'd call it a bull channel. However, channels eventually evolve into trading ranges. It's like this over here. We call this a bull channel. But you know eventually the bull channel is going to evolve into a trading range. In this case, it went sideways instead of testing all the way here or here. So where do we go on Monday? Monday has a high 1 above today's bar. I suspect there's probably sellers above, but the channel is tight, which means the sellers, it's probably more of a minor reversal than the start of a strong sell-off. So probably minor reversal up and buyers below. Okay, thanks everyone for watching, and I will talk to everybody soon.